ticker symbol ABL for those listening. What are they? Well, you already introduced them as they buy out policies, etc. So what makes them interesting to you?
So this is a really niche market. And so life insurance in the US is a $13 trillion asset class. This is a huge chunk of middle-class wealth as their life insurance policy. And the United States, it's based on a Supreme Court ruling from 100 years ago that with life insurance, you actually own something. You own your policy. This isn't true in Canada or a lot of other countries. If you have a contract with a life insurance company, it's not that you own some physical asset that you can control. But in the United States, it is that way. And what that means is you can sell it to somebody. So this is a very US specific asset class. And 90% of life insurance policies never pay out. It's a $13 trillion asset class, and 90% of them never pay out, which is kind of a shocking number. And the reason they don't pay out, it's not because the life insurance companies are a bunch of crooks and they don't pay you. It's that you get this life insurance policy when you're 35, 40 years old. You're worried about dying and leaving a wife and 2 kids with a mortgage that they can't pay and college they can't afford. But then, most people make it to 65. Most people live to see their mortgage paid off and their kids graduate college. And then you say, okay, well, now that I'm retired, now that I have a 401k, now that my kids are graduated college, now the house is paid off, why am I still paying this company every month? Why am I still sending however many $100 a month to the life insurance company? I don't need it anymore. I have enough savings to cover my funeral. So people see when they're 65, they're 70 years old. For one thing, Social Security is much less than what they were earning in their careers. So their income now has been squeezed, and this bill no longer seems appropriate. So a lot of people will just stop paying without realizing that they have residual value that they own there. So 90% of a lot of this is just educating the public. 90% of life insurance policies never pay out because people stop paying the premiums. Now, if you're savvy enough to not just stop paying the bill, you can call the life insurance company and they will say, okay, well, here's the surrender value. And it's very similar to the annuities with Jackson Financial, that you just have to accept what that company offers you for surrender value. And it's never amazing because it's a one-on-one negotiation. And they obviously still want you as a customer. But because you own the life insurance policy, there's the secondary marketplace. But again, it's all about educating the public. People don't know that it exists. Abacus Life typically pays 7 times what the life insurance company offers you as a surrender value. So if the life insurance company offers you $50,000 if you're surrendering your life insurance policy, Abacus Life will pay you $350,000. And suddenly it becomes a sizable amount of money. Enough to actually make a difference in your lifestyle for the rest of your life. And again, this market is so small. It's a $13 trillion asset class. Last year for the entire United States, only 4,000 policies changed hands in this marketplace. 4,000 people out of 330 million sold their life insurance policy in the secondary marketplace. And Abacus Life had a 25% market share. They did 1,000 of those. So Abacus Life, their entire business, they bought 1,000 policies last year. Out of 4,000 policies trading hands, out of a $13 trillion asset class of 330 million people. This market is so potentially huge. The growth prospects ahead of Abacus Life are so enormous. And it really starts with, I don't know if some influencers are going to blow it up on Facebook or what, but people that have life insurance policies need to learn. It's really about educating the market that it has a residual value and you can sell it. And don't trade it into the insurance company. Don't stop paying the payments. Sell it to somebody else. And this market could be enormous. And then another aspect of it is the original founders. Abacus Life is a 20-year-old company, and it has its 3 original founders that still own about 1/3 of the company, and the CEO that they hired. And the 3 founders gave the CEO some of their own personal stock. So the 4 of them together own about enough to prevent it being taken private. So the management team is in control to take the company as far as they want to go. And this market could be enormous. I mean, you're talking about Abacus Life. Let me see what their revenues were last year. So they did $114 million of volumes. And I think that's, call it I think it's somewhere around, I have the numbers in my write-up, but out of a $13 trillion asset class, the entire marketplace that changed hands was, I think, under $2 billion. So this is a world where there's so much room to grow. And another thing about the baby boomers. So when I talked to them, when I was a financial advisor, I would ask people, because I'm trying to match their financial goals, what do you think of inheritance? About half of the baby boomers don't believe in inheritance. Their attitude is, I paid for college, the kids are on their own. And college is expensive. So half of me says, fair enough. That I'm not trying to throw some shade on the baby boomers. Paying for your kids' college is a huge nugget. But when you're dealing with this large demographic with 75 trillion of assets under management, they don't believe in leaving something for inheritance. They see this life insurance policy. If they knew they could cash it in, I think the line would be around the block. So again, it's really just about reaching people, letting them know this is a possibility. Because when they're 70 years old and they compare their Social Security income with their monthly life insurance payment, it just doesn't make sense for them anymore. So the growth potential is huge here. And then just back on Abacus Life, once they pay to acquire this policy, there is such an appetite from institutional money managers. They can turn around and sell pretty much at these volumes. They can sell an endless amount. There is no limit to how much any of these things they can pass on to willing private credit companies. So once they pay 7 times what the insurance company would pay as a surrender value, they slap a 20% markup on it and sell it to a private credit entity. And they could do that. This market is so small compared to how much institutional money is out there to invest. They could do that as many times as they have people clicking on their website to surrender the policy. So yeah, it's a fantastic business, and all their competitors are private. So this is the only public company that does this.
I spoke to someone who is former IB, and they told me that they were working on taking one of these, not Abacus, but another one public, and their ethics committee came in and shot it down because it seems like this is like the sin stock of finance, so to speak. So, well, there's cigarettes, coal companies, right? This appears to be in that same vein, but financial business. So I found that interesting.
Yeah, well, I asked, so I was a financial advisor. So my first thought when I heard about this is, could a financial advisor recommend this, right? I mean, would you get in trouble if you're telling people to surrender your life insurance policy? And so this is what I asked the CEO when I talked to him about a month ago. And so about half of Abacus Life's volume comes from their direct advertisement, and half comes from the financial advisor channel. And they said, no, the financial advisors love this. If you have somebody that their Social Security income doesn't match up with their expenses, and their children are all career professionals, doctors, lawyers, engineers, and the children don't need the money, this is a fantastic thing that you can do for their client. You can lower their bills because there's one less bill to pay, and you can give them a huge nugget of cash. So my understanding is that the regulators that monitor financial advisors think that this is a positive thing. So I wouldn't say from that end it's this dirty sin stock. But what I've heard is even among financial advisors, even the financial advisors don't know that this exists. So right now, the average policy size that gets surrendered is $1.7 million. So think about what kind of a individual has a $2 million life insurance policy. This is, you're really dealing with right now the 4,000 policies that changed hands. This is really a white glove, high-end, upper class situation. When information gets out to all the Edward Jones advisors of the world, how many people in the middle class have a $250,000 or a $500,000 life insurance policy? And if they could surrender that for $150,000, that's a life-changing amount of money for somebody that's on, if you look at the median 65-year-olds, you take all the 65-year-olds in the country and line them up, the median 65-year-old has 0 retirement savings. The median 65-year-old owns their own house and has nothing else. So you're dealing with people that Social Security is their income. That's their whole life. So they own their own house and they're living on Social Security, which as a husband and wife together with 2 Social Security incomes, it is fine. You can get by on that. But what usually happens is usually the husband passes away first, because when people get married, the husband tends to be a few years older, and men tend to live a few years less. So every American on average has to plan on the wife being a widow for about 10 years. Now you own your own home, but you're paying for property taxes, insurance, and lifestyle and medication all on one Social Security income. It becomes unworkable. It becomes untenable. So there is this, and again, that's the median 65-year-old. There's very well-to-do people at the top end, and at the bottom end, there's people who, you know, live with their kids or live with their nieces and nephews. But at the median, there's a lot of people that $150,000 or $200,000 would make a huge difference to having more dignity in the last, 10 or 15 years of their life. And again, the information just has not spread. Right now, only the highest net worth people are doing it because they're hearing about it from only the highest net worth financial advisors. The rest of the country has just never even heard that this exists as a marketplace.
So it's really about awareness. Someone asks, we have a couple questions that came in. So how do you educate people at age 65 and over? TV ads? One question.
So both, and Finance of America companies is my favorite, but Abacus Life and Finance of America companies, their advertisements are on television, at the gym, kind of back to back. And Finance of America companies, it's kind of my favorite because so again, the marketing for these kind of products, so not for Abacus Life, but so Finance of America companies does reverse mortgages. And again, typically you're in a situation where the man has passed away and you're left with the widow. Well, look at the marketing materials for Abacus Life, or for, Finance of America companies. And who do they have as their face man? Tom Selleck, right? You find the hunkiest piece of senior citizen beef that you can find and make these sexy advertisements for these widows. It's just so classic. So Finance of America companies does have their TV ads, and they've got, and Tom Selleck, he was the main character for that show, Blue Bloods, about the police family in New York. Anyway, but this is since time immemorial, you get these, whether it's the actor from Law and Order, whoever it is, but somebody very handsome to a 70-year-old woman that they feel they are very trustworthy. That's who's going to be the face man for advertisements for these sorts of financial companies. Abacus Life, less so, because, you're assuming the husband's still alive if he wants to cash in his insurance policy. But yeah, so a huge chunk of awareness is just direct advertising. The other chunk of awareness in Abacus Life is getting to the financial advisors. And so I do have some criticism with Abacus Life. They're doing some aggressive growth, and they're doing this aggressive growth not vertically, not horizontally, but vertically. So they're already 25% market share in this very small market. But they're doing, so one thing is they bought an ETF company. They've also expanded into mutual funds. So some of this, not all of these endeavors I think are going to be successful, but I think some of these are going to pay off in other ways. So Abacus Life needs to get in front of financial advisors as often as possible to teach them that this is a possibility. And by launching ETFs and mutual funds, it's another way of getting in front of financial advisors at their conferences and teaching them that this product exists. I don't know that the ETF is going to be so successful. So the ETF, the idea is, instead of having so there are target date mutual funds. So suppose you're retiring at age 65, you might have a year 2045 target date retirement mutual fund. When you're young, it's more stocks, and when you're older, it's more bonds. Abacus Life, with their proprietary data on when people die, they want to make not a target retirement mutual fund, but a target expiration. So instead of targeting your retirement date, you target when you're going to pass away. And they have a calculator online, how long do you think you're going to live, all that sort of stuff. I don't think this product is ever going to be fantastically successful. But if this gets their foot in the door for financial advisors and teaches financial advisors that they could help their customers surrender their life insurance policies, I think of it like the vacuum cleaner salesman that throws a bag of dirt in the front door, that they say, hey, now I can show off my vacuum as I clean it up. So they have these online calculators to estimate how long people are going to live and things like that. Again, I think this is going to pay a benefit in teaching financial advisors that the product exists more than the ETF is going to be successful. The mutual fund is different. The mutual fund, I think, is going to be successful. So once they've bought these insurance policies, if they had unlimited capital, Abacus Life would hold a lot of them to maturity because they're going to be worth much more when people pass away. right? They're like an option with a positive theta. They become more valuable every year. But they turn around and sell them for a 20% markup to private credit companies. They're creating a mutual fund as a way to receive these life insurance policies so that retail investors would be able to invest in these life insurance programs. Again, it's a niche product, but it's interesting enough that I think that they'll be able to speak at so many conferences that financial advisors become aware of it. Like, oh, my clients can invest in this unique product, but also life insurance settlement exists, and I can help my clients sell their life insurance policy rather than stop paying it. So again, they have these products that I think on the face of it, I'm not super bullish. The ETF, it's such a competitive industry to launch an ETF. It's such thin margins. I don't think just personally, I don't think their ETF is going to be so successful, but I think it's going to help, if that's considered a marketing expense and how to reach all these financial advisors, I think it's prudent. But the mutual fund, creating a niche product to stuff this mutual fund full of these life insurance policies, that I actually think could be interesting, because there are a lot of high net worth, retail investors that would buy something, a private credit type instrument with a 9, 10, 11% return would be very interesting to people. So again, one of the criticisms for Abacus Life is they're doing all these acquisitions and they're increasing the scope of their business pretty enormously. I don't think they're all going to work, but if even one of them works, it's just enormous value add to the business. And I think as they're doing this, it's again, rather than spending all this money on television ads trying to reach people when they're in the gym, I think, launching an ETF and going to conferences and reaching financial advisors that way is just another form of marketing.
Okay, so because that was one of the questions we got in is, okay, this product, the main product, is very attractive. They understand the economics, etc. Why are they going into these other business lines? Like, what's the point of it if this thing has a huge market opportunity and it's so profitable and so attractive? Why spend the effort over here? It's to generate like a sales funnel.
See, that's my belief, is that it's to generate a sales funnel. I did speak with the CEO on this, and I'm not always a cheerleader, so I think I kind of grilled him. One of the areas where they're expanding, and so you want to watch out for empire builders, right? Empire building CEOs are a bad idea, and I don't think Jackson Financial is going to fall into this risk. I think Jackson Financial is a risk they'll be taken private, not a risk they'll do bad acquisitions. Abacus Life, so I try to get into this mindset. Is this guy an empire builder? He's going to destroy value. But I don't think the mentality is about empire building. The mentality is almost like we're going to butcher the whole hog, right? We're going to take everything we have, we're going to add value from it. So one of the acquisitions I asked them, what haven't you bought that you would buy? What are you still in the market to buy? And they said they wanted to buy a financial advisory firm. And I said, whoa, what the heck are you doing? Because sometimes in business, right, you need to rely on the financial advisor network to be half of your sales funnel. Why would you compete directly with them and then alienate them? Why wouldn't they then choose the second and third place in the market once you're a direct competitor with them? And the mentality was, well, we have these tens of thousands of inbound queries into our website, into our office every year. That is an enormous amount of value that we could do something with. So again, the mentality is not like we're going to plant a flag, we're going to empire build. The mentality is, how do we add the most value with all the assets that we have? That is a good mentality. And I tried to tell the CEO I thought buying a financial advisory firm is a terrible idea. I don't know if he listened to me or not. But I think the good thing is that those financial advisory firms are generally so expensive, I don't think they'll find one that's an appropriate acquisition. But that is a risk of the business, is bad acquisitions are a big risk. As far as the ETFs, again, I don't think the ETFs, I don't think they're going to become the next BlackRock or the next Fidelity. But because it's such a highly competitive, such a thin margin business. But at the same time, if you just consider it a marketing expense to open the funnel and reach financial advisors, I don't think it's a bad form of marketing. But I think the mutual fund, stuffing a gated mutual fund with this private credit instrument, with these life insurance policies, that and then having retail financial advisors put their clients in that, I actually think that one has a good chance of being successful, and that it could easily double the size of the business. So yeah, that I get where critics are coming, where this core business is so attractive. Why are they doing all this other stuff? If one out of the four things they're trying to do actually sticks, it's going to add billions of dollars of value to the company. So, you know, I'm not against them being in the arena trying things. And I didn't get the vibe. So again, the three founders have been in this business for 20 years. They own enough of the company to control it mostly. They might make some mistakes along the way, but if any one of the 3 or 4 things they're doing sticks, it's a home run grand slam sort of thing. I'm not against them out there trying.
Yeah. Okay. So you want them to figure out if there is another way to add value to shareholders, but okay. And I'm going to think about how to ask this next question on Abacus, but we'll do this question first. Where are you thinking the value is right now? Where do you think it's going to go with the information we have in the current business model that they're at now? So how are you thinking about this valuation?
This one's so hard because the market is so small. You're talking about 4,000 life insurance policies changing hands. So, and then people say, okay, well, they're 25% market share now. Will they always be 25% market share? Who knows, right? I mean, if the life insurance settlement market goes from 4,000 policies a year to 100,000 policies a year, which is entirely possible in a world where 90% of life insurance policies are just surrendered, the entire marketplace for life insurance settlement could go to 100,000 policies a year. Is Abacus Life still going to have 25% market share? I mean, who knows, right? Jackson Financial, I know, they pay the highest commission. They've stayed at the top of their market share. They're growing aggressively in areas they try to compete in. They're the quality leader. I'm much more confident Jackson Financial is going to stay on their king of the mountain for a while. But whenever you're king of the mountain, there's always competitive risk. Abacus Life, are they going to stay king of the mountain with 25% market share? Who knows, right? But are they gonna settle more policies next year than this year? Almost certainly. I mean, the market is growing, and they're going to be a beneficiary of the market growing. Awareness is out there. People are hearing about this thing. And I had some of my subscribers on Substack say, "Man, I wish I knew about this 2 years ago when I was dealing with this with my dad's life insurance policy." People just need to know this information exists, and as that information gets out there, the marketplace is going to explode. You know, is Abacus Life the best way to participate in that? It's the only way to participate in it. They're the only public company. So if you want to be a part of the baby boomer retirement party, it's a way of doing it. But yeah, I have no way of knowing. Again, is it going to be 10 years from now? Is there going to be 100,000 policies settled every year? Is it going to be 20,000 policies? I don't know if this market is going to 5x or 10x or 20x, and if Abacus Life is going to keep their market share or whatever percent. But they've been a pretty big name in that world. They do have some brand reputation, right? They've been in it 20 years and they have pretty good market share. So they're doing something right, and they're the only public option. So I think it's sort of my ability to model. Like if I told you 3 years from now, this is what their revenue is going to be, I have no idea. Nobody has any idea. But this is quite a security where a lot of good things could happen to it. And sometimes that's an interesting part of the portfolio too.
So I think like with Abacus Life, one of the questions that I guess like people are going to focus on is we get like the sales funnel, we get the opportunity ahead of them. Will the market in time, you think, appreciate this product as its own thing in its own right? Or do you think there's always going to be this like stigma attached to it? Because I mentioned briefly it might be viewed as like this sin stock. Because coming at it, and I think you would agree with this, the economics of the product are really attractive. And should investors look past that and just say, well, at the end of the day, if the economics are really attractive, we're going to have like, I don't know, a Jackson Financial situation where they just start devouring shares at some point. And so you should ignore that is what I'm getting at. Would you agree with that?
Yeah. So, so financial firms as a category tend to be, a pretty trusted part of the market. It's all a trust-based industry. I'm not so sure that the sin stock metaphor applies here. I mean, I had my own concerns, like as a financial advisor, would I be able to talk to clients about something like this? And my understanding is all the regulators, the insurance regulators, and then FINRA, the Financial Regulatory Authority, that this is sort of everything is thumbs up, everything is okay. in a world where 90% of life insurance policies, like you pay the life insurance company for 30 years, then you get nothing. I think it would be sort of a consumer advocacy thing to make sure that people are getting something out of their life insurance policies. So I don't see it in the same sin stock. I think it's a niche thing. Small caps are undiscovered. So as it grows, and so it's also a little bit like Peloton, right? So Peloton, one of the reasons why it was so successful is that people that worked in finance could afford one and they bought one. So, I mean, how much of Peloton sales were to finance professionals in New York? An enormous percentage. So sometimes being a public traded company is part of the marketing of this thing. I wouldn't be surprised if going public and getting that brand recognition and ringing the opening bell and things like that are part of how they reach financial advisors and how they spread brand awareness. I don't think the sin stock situation really applies here. I think it's more going to be about, you know, the growth and the stability of the company. But this is a much earlier stage. They've got such a long runway for growth. So where I think Jackson Financial is going to have its re-rating in 3 to 5 years, Abacus Life, I mean, I'd love to see where they are 10 years from now. I mean, so many wonderful things could happen to the company, but like trying to put in a discounted cash flow model and model it out 1 year at a time, nobody has any clue. This is just it's really much more of a, I don't want to call it a lottery ticket, because when you have you've got a 20-year-old company where the founders still own a third of the company, they're doing a good job and they have good brand reputation. You know, it is a good business. It's just, you know, $13 trillion asset class and $2 billion in policies changed hands. Like we have no idea what this market is going to grow into once everybody figures out that it exists. It's just it's a new frontier. It's the Wild West, right? The wagon trains are heading. That's probably just smart to jump on the wagon train, whether you end up being, you know, Levi's and selling picks and shovels, or however you make money off of the gold rush, right? I mean, the wagon trade is heading out and it's heading to a new land of prosperity and opportunity. Hopefully it doesn't get raided by Indians.
Hopefully. All right. So on that note, I want to take us over to FOA, which is the last of the silver tsunami stocks we would talk about. Now, this one in particular, I think is it's the largest. There's one other one, but they do a bunch of other things. It's the Mr. Cooper competitor that also does servicing of mortgages. They also do reverse mortgages, to my understanding. But these guys are the leader. Finance of America. Okay, we went over a little bit what reverse mortgages were before. Can you get into why this company is interesting in particular?
Yeah, so again, it's part of the silver tsunami, the secular tailwind, that you have these baby boomers, husband and wife. The median boomer, they own their own house and they have no retirement savings. 2 Social Security checks are very comfortable, but at some point, usually the husband passes away and the wife is left alone. The mentality toward nursing homes has kind of shifted. The medical industry now thinks that, nursing home in place, retiring in place is better for people. It's better if you can stay in your own home. And you're seeing this explosion of services of, you know, door-to-door blood tests, door-to-door intravenous things. So getting nurses in vans going into people's houses is also exploding in the medical industry. But the mentality has really shifted to people, you know, sort of nursing home in place in their primary residence. And it's very hard to do on one Social Security check because the insurance and the property taxes are expensive. So the number of, and again, you think about, you know, before the automobile, the vast majority of people lived and died within 20 miles of where they were born. It's just the human condition has changed so much that now you get a college degree and you move across the country, right? Mm. People don't live in the same hometown as their parents. You talk to baby boomers like, okay, do you have kids that want to live in your house? Do you have kids that want to inherit your house after you die? They say, no, I'm in Denver and my kids are in California, or I'm in Massachusetts, my kids are in Texas. Right? People don't need to live in their parents' house. They don't need to inherit their parents' house in the same way they did a couple generations ago. So the mentality is like, okay, well, what good does it do your estate, you know, if when you pass away, you sell an $800,000 house in Massachusetts? Is that really a benefit? Or is it better to have a mortgage company send you a check in the mail every month for $1,500 or $2,000, or that's going to dramatically improve your quality of life right now. And your kids have their own house. Your kids have a 30-year mortgage on their own house in Texas. Your kids don't want your house or need your house. And inheritance is another funny thing where if people are dying when they're 85 and the people receiving their inheritance are 60, well, what does a 60-year-old need with $800,000? They're at the end of their career. They have a 401k, their own mortgage is paid off. So the whole mentality around this is maybe the better thing is to start getting a monthly income on this asset, because the kids don't need to inherit the house. They don't need to live in the house. And the baby boomers want to throw this party and go on some Royal Caribbean cruises. I've got an uncle that was the CEO of a company in California, and he retired in his 40s. Then he unretired because he was bored. He counted up all the days he spent on a cruise ship. It's over 4 years. The dude has been cruising for 4 years. This is what the baby boomers want to do with their money.
Yeah.
And again, the mentality is, I paid for the kids' college, they're on their own, which, I'm not trying to criticize the baby boomer generation too much. I think it's fantastic they paid for their kids' college. That's not what the Chinese are doing, right? The Chinese believe in this legacy dynastic wealth, right? But there's this zeitgeist. Even Warren Buffett had this pledge that he was going to not leave his money to his kids. And then every year he gets older, he kind of undoes some of that pledge and leaves more money to his kids. Because people do care about their kids more than they care about total strangers. But anyway, they don't believe in inheritance. Their bills are piling up. The older you get, your medical expenses start growing. You're on more and more medications. Property taxes are going up. Insurance costs are going up. Social Security just doesn't cut it, especially on one income when one spouse passes away. So the room for the reverse mortgage market to grow is enormous. Not as enormous as life insurance settlement, but it's still a huge growth opportunity. Finance of America has this, when they went public right in the peak of the zero interest rate post-COVID 2021 peak. If you look at their stock chart for Finance of America company, it looks like a water slide.
I'll bring it up.
Yeah. Oh, it's a shocking chart. Finance of America originally was a lot more like a rocket companies, where they were trying to do a lot of things. And as they went into this bear market in 2022, 2023 with rising interest rates, they went from being a company that did a lot of stuff to being a company that only did reverse mortgages. So they sold off all the other parts of their business that were handling any other sort of mortgage servicing. It's a lot like rocket companies having this big portfolio of different products and services. Then they narrowed themselves down to doing only reverse mortgages. And then they acquired the second largest player. So they were the market leader at like 20% market share. And they acquired the second place with like 15 or 16% market share. And they ended up with something like 40% market share in reverse mortgages. So they're like far and away the market leader. They have lost some of that ground. So Mutual of Omaha in particular is being a little bit more aggressive with this stuff. But it's not a secret. Like everybody in finance, I think, knows the baby boomers need this product, and it's going to be a big deal. Now, the sales pipeline, right? So this company, I think they do, on average about $3 billion of volume in a year. But that had not $3 billion of revenue, but as far as like the total value of houses, right? Because if you're talking about the commission on a mortgage, it's 3, 4, 5%. We talk about the total value of all the mortgages outstanding. It's about $3 billion of mortgage nominally a year. With rising interest rates, and also much more with rising interest rates, but we had a banking panic when Silicon Valley Investment Bank and First Republic went out of business and they were seized by the regulators. When you're talking about marketing a company to a 70-year-old widow, they're not going to bite on a complicated transaction, one, during COVID, because they can't talk to anybody in person. And these sales are very high trust sales. They have to do it in person. So volume crashed during COVID, and then volume crashed during the banking panic. So I don't think rising interest rates hurt volumes anywhere near as much as the collapse of First Republic or Silicon Valley Bank. But this company's volumes went from $3 billion a year in volume to like $1.5 billion. And operationally, they were losing money. So whenever they sign a new contract, they pay themselves a sales commission. And so there was a couple years where they were losing money operationally. And I think a lot of people had pegged this company for bankruptcy. So when I first wrote about it, it was before they did a reverse splits. It was 50 cents a share, so $5 a share. So it's been a 4-bagger since I wrote about it. But I looked at it and I said, for one thing, the volumes are down because of this banking panic and because of COVID. But volumes are going to come back because this is a very needed product. And the other thing is the way they make money is very interesting. So one aspect of it is when they sell a reverse mortgage, they pay themselves a mortgage origination fee. And that is kind of their operational income to keep the lights on. But there was another aspect of this, which is very niche and very specific. And I don't think that it was well understood. So they have to send this old lady a check in the mail every month. And where are they going to get the money to do that? Larger companies like Mutual of Omaha, they have a diversified business. They can send the old lady a check in the mail every month from the other aspects of their business. They're making money. But if you're a pure reverse mortgage company, where are you going to get the money to send this old lady a check in the mail every month? What they do is they take all the home equity that they've accumulated and they sell it as a mortgage-backed security, right? So they take their home equity and they sell it and they take that money from the mortgage-backed security sale, and that's what they pay the old lady with the check in the mail every month. But something really bizarre happened when the yield curve inverted. And there are very few ways to have a direct exposure to the yield curve. So these reverse mortgages, so Finance of America Companies has outstanding about $27 billion of home equity and mortgage-backed securities from the books of business they've sold in the years past. So they've got about $27 billion of past business outstanding. 20 billion of that is Ginnie Mae conforming. So it's same as if you buy a mortgage, you've got conforming or non-conforming mortgages. So if your credit score is in the right range and the house is of the right kind, then you get a conforming mortgage that's kind of insured by this sort of government entity called Ginnie Mae or Fannie Mae or Freddie Mac. $7 billion of their mortgages are non-conforming. So this is $7 billion outstanding of mortgage-backed securities and $7 billion outstanding of mortgages on people's houses. Now, what happened when the yield curve inverted is Finance of America Company is accumulating equity on these people's houses at the floating rate mortgage, the going rate for the floating rate mortgage, which is something like, SOFR plus 4% or SOFR plus 3.5% or 4.5%. So, but the mortgage-backed securities they've issued, so they sell the mortgage-backed securities to get money to pay the old lady her monthly check. The mortgage-backed securities they issued were 5-year fixed. So they had $7 billion outstanding of 5-year fixed that they owed, but they were collecting, SOFR plus 4% of the overnight rate. Well, this bizarre thing happened with the inverted yield curve that for 2 years, the overnight rate was higher than the 5-year treasury or the 5-year mortgage-backed security or the 10-year treasury. So Finance of America Companies has it built in to capture a very thin spread, maybe about 1.5% or 2%, that's going to reimburse them for the upfront commission they paid themselves when they sold the mortgage originally. But for 2 years, they had a $7 billion book of mortgages where they were paying fixed rate 3.15%, and they were receiving, I think, 7.8%. So they had a 2-year period where they were making a 3.5% spread on $7 billion, which nobody knew about. And it was amazing is even on earnings calls, they tried to explain this to people, and the analysts just didn't really get it. And I used to be a professor at a university teaching finance. One of my former students is an equity analyst, and his company covers Finance of America. He doesn't, but one of his colleagues does. So I asked him, can you go to your colleague, explain this to them, and tell me what they think about it? And he called me back. He says, I explained it to them twice, and they still didn't get it. And I understand this is sort of an arcane, sort of a complicated thing, but even the analysts listening to their earnings calls did not understand this. For 2 years, with the yield curve inverted, they were receiving 7.8% on $7 billion, and they were paying 3.15% on $7 billion. And that took place for 2 years. That money is finally going to show up. So at the end of the 5-year period, when the mortgage-backed security matures, they essentially issue new mortgage-backed securities to repay the old ones. When that happens, the 5-year CD outstanding price is going to rise, and the spread is going to come back down to the normal 1.5–2% spread they're usually accustomed to. So again, this company has hundreds of millions of dollars that they have earned for the couple years when interest rates when the yield curve was inverted. And that money is going to show up to them in cash when those mortgage-backed securities, those 5-year MBSs mature. So they're going to essentially reissue these mortgage-backed securities. And when they do it, they're going to say, oh, surprise, surprise, here's a residual of a couple $100 million or a few $100 million this year. So this is, so not only have volumes picked up so that they're operationally profitable again, not only do they have operating net income now, but they've got these residuals from their non-conforming mortgages. That's hundreds of millions of dollars of cash that's going to arrive, which they should be able to use to hopefully settle their debt. And then who knows, maybe even return capital to shareholders someday. So Finance of America Companies was a pretty amazing thing to have something that, again, it was in their investor presentations. They talked about it in earnings calls, and even people that should have gotten it just didn't really get it or understand what was happening. I know it's kind of a weird thing, but the first of those mortgage-backed securities matured in April. I think there's about 26 of these mortgage-backed securities outstanding that are going to come due within the next couple of years. But again, there's hundreds of millions of dollars of cash coming into this company that nobody was planning for or accounting for until finally, I think, maybe through my Substack or other places, people figured out about it, and the stock price jumped up to $30, and then people got bored with it, and it fell down to 20 again. But for the long term, secular tailwind is the baby boomers need access to this money from their homes. In the short term, there's, again, hundreds of millions of dollars that they've earned from their existing book of business that's just going to come into them over the next 2 years. And then as far as the nature of the market, again, it's a competitive market. Other people are trying to get into this space. Mutual of Omaha is taking a little bit of their market share. When times were tough for them in 2023, they kind of pulled back on advertising a little bit. So we're going to see how they bounce back in market share now that they've restarted their advertising. Now these widows see Tom Selleck on their TV screen again. But yeah, I think it's a fantastic business, and it was sort of a undiscovered gem.
I really actually like the economics here. So for a reverse mortgage, and you said this figure already, the 5-year mark, right? When I just quickly went through the investor materials, they said like they have like a 5-year break-even period. If my memory serves correctly, correct me if I'm wrong there. Is it 5 years?
Yeah, so when they need cash to pay the widow her monthly income, they take her home equity, they bundle it as a 5-year mortgage-backed security, and they sell it. Now, it's also callable after 3 years. So if interest rates moved against them, they can call it in after 3 years if they want to. But if interest rates are moving in favor of them, they get it for a full 5 years if they want it. So that's one of their risk management strategies, is it's a 5-year mortgage-backed security callable after 3 if interest rates have moved against them.
What I like about the economics here, though, is on the asset, right? They get when you do a reverse mortgage, what's the amount that you pay over the totality on average versus like the equity of the house, right? What happens? Who gets the interest rate moves against them, but who gets the full equity price appreciation? Still the owner of the house, correct?
Yeah. So exactly. Suppose you start this reverse mortgage and your house is worth $400,000.
Okay, $400,000.
And after you've been doing this reverse mortgage for 10 years, your house is worth $600,000.
Mm-hmm.
Well, the owner is still the owner of the equity of the house, right? The mortgage company has this nominal claim against the house, this dollar term claim. But yeah, if you're living in your house, you still get the equity appreciation, which makes it very nice for the customer in a high inflation world. And another thing about mortgages, when you go buy a house and you sign up for a 30-year mortgage, and I did this to my students when I was a finance professor, show them the amortization table, say, okay, how much home equity have you accumulated after 5 years? And it's almost nothing, because these initial payments are almost all interest and almost no equity. But the flip side of that is when you start this reverse mortgage process, like, okay, your first check in the mail comes for $1,500. You have this home that you paid off free and clear for a 30-year mortgage. Now, the first check in the mail comes for $1,500. The interest payments you're making on that, and the interest, again, is just more home equity coming out of your ownership of the home. But the interest payments, the snowball is starting out real slow. If you've had a reverse mortgage for 5 years, it's not really a burdensome amount of interest that's accruing, because now the snowball is taking time to accelerate. Right. Once you've had the reverse mortgage for 15 or 20 years, okay, now the interest is a sizable chunk. But in the same way that a new home buyer for the first 5 years of their mortgage is accumulating almost no home equity, for somebody doing a reverse mortgage for the first 5 years of it, the interest is accumulating really slowly. So it's kind of it's nice in a lot of ways that the homeowner, if the houses are appreciating, they keep that difference. It also makes it pretty darn hard, right? If somebody starts a reverse mortgage when they're 70 and they live to be 85, it's hard to run out of home equity, right? If they price it appropriately. So these mortgage-backed securities they issue, when a typical lender does a mortgage-backed security, the loan-to-value ratio on a new mortgage might be 95%. Maybe people bought the house with 5% down. The mortgage-backed security that Finance of America issues, the typical loan-to-value is 43%, right? So people will have had to have a reverse mortgage for 10 or 15 years before the Finance of America company even owns 40% of their house, which means the safety on these mortgage-backed securities. If you want to buy a mortgage-backed security from a mortgage broker with a 95% loan-to-value ratio, maybe there's risk there. But what would have to happen to the American housing market for a loan-to-value ratio of 43% to not pay out? So these are some of the safest, some of the most desirable mortgage-backed securities that you could issue out there. So their offering for mortgage-backed securities are always oversubscribed. Right? If you have a choice between a mortgage-backed security with a 95% loan-to-value or a 43% loan-to-value, these guys as mortgage-backed securities are amazing. You know, the only downside is it's 5 years callable after 3, so you can't enjoy the income from it for a long time. But there's also, you don't have the refinancing risk, right? So for a typical mortgage, so suppose you want to collect this nice 7% yield on this mortgage, but what happens if interest rates fall and the customers refinance? So you don't really have the refinancing risk here with the reverse mortgages either. So these are very, very desirable mortgage-backed securities that get sold. And it seems to be again, because of the way that the home equity keeps increasing and because of the slow rate at which compound interest starts in the initial 5 to 10 years, and because of the age at which people start this policy, it is very, very hard for somebody to live long enough and for home prices to do poorly enough that Finance of America companies is in trouble at the end of it.
And so just so I understand this correctly, and again, correct me if I'm wrong. So there's no limit to the time frame of how much someone can have an open policy with Finance of America. I can have it open and keep receiving my check for 10 years, 15 years, as long as there's equity to be sold to them, basically.
Yeah, and I this is a company that I've tried to reach out to. So I was lucky enough to get my foot in the door with Abacus Life and talk to the CEO. There are some aspects of this business that I don't know exactly what happens. Like if you suppose you live to be 95 years old and you run out of home equity, what happens? Do they just cut you off or something like that? There's a lot of mechanics at the very long end of it. I don't know exactly how it works, but right now, so as I send emails to investor relations and say I'm a Substack author, I have 4,000 subscribers, I'd like to talk to you, I'm getting mixed results. So I've been able to get in front of a few CEOs and write up some summaries of those conversations. But maybe if I get up to 10 or 15,000 subscribers, I'll get my foot in the door a little more easily. But it should be fun to look forward to in the future. But I've emailed them and they haven't gotten back to me.
Yeah, sometimes you knock on doors and they don't. Yeah, but
yeah.
I hope you do, because I would like to hear from them.
Yeah, me as well. So there are some unanswered questions, but for the most part, again, they have enormous market share. Their market share has fallen. Mutual of Omaha has been aggressive, but at the same time, there were a couple years where they weren't advertising as heavily. So now that they have positive operating income again, now that volumes have picked up, I think I'd be curious to see how their market share settles out. But yeah, it's a secular tailwind. It's the silver tsunami. Baby boomers need this service. They're going to need to get $1,500 a month or $2,000 a month from their primary residence sent to them to sustain their lifestyle, which is why I love this picture of my mascot partying with all the boomers.
Of the three that we've discussed so far, which one are you the most excited for? Is this number 2 or number 3 or number 1?
Well, it's kind of the old story of risk reward where, Abacus Life, if things go well, it's enormous. I mean, Jackson Financial is so well established and they already have such a big book of business and such large market share. It's not like Jackson Financial has unlimited upside. They have very nice upside as they do share buybacks, so they're undervalued and they, triple from re-rating. I think it's going to be a 5x in 5 years, but I'm pretty sure it's not going to be like a 20x in 5 years, right? There's an upper limit to what people are going to pay for the company. Finance of America is in between, and Abacus Life is kind of the new frontier. So I'd say from a risk reward standpoint, Jackson Financial is the safest, with still with a very incredible return possibility. Finance of America has a more moderate risk return, and Abacus Life is, wild and aggressive, just like bungee jumping or parachuting or something like that. It's a wild and aggressive situation. But if things go well, especially, a $13 trillion asset class that right now is only doing $2 billion of volume a year, and you've got somebody with 25% market share. If Abacus Life does well, over 10 years, it could be such an enormous multi-bagger. So again, I would just rank order them from risk return. Jackson Financial is the safest. Finance of America is number 2, and Abacus Life is the highest risk return profile.
I would actually, well, without comment on Abacus, I would actually agree with that assessment. And from what you've explained here so far with FOA, this is the one I wanted to pick your brain at the most, because it's the one I do not follow at all. And it looks like they reported earnings today. I just was skimming through it while you were discussing this. Market, have it open in front of us. Market seemed to like it. Hope you're happy.
Yeah. So, when I first started writing about them, they still had operating income losses, but their residual income from their book of business was so much larger than that if you take the whole thing in its entirety, they were profitable, but the accounting rules of it. So the way these residual income gets actually added to the balance sheet is about a year before the CD matures. So maybe about year 4 of the CD, you have a mark-to-market gain. And a couple quarters ago, when it went from like $5 to $35, there was 2 things that happened. One is they just flipped to operating income positive, and they had the first mark-to-market gain where they said, hey, book value is $150 million more than we thought it was because of this mark-to-market gain. But then 1 year later is when that book value mark-to-market gain actually becomes cash when they reissue those mortgage-backed securities. So there's more positive catalysts to come as the secular tailwind. Their volume should increase, their profitability should increase from, once they've got their fixed costs covered and their marginal costs, are lower. So they should have operating leverage. And then once these residuals come in and they get, surprise, here's a couple $100 million this year, a couple $100 million next year. So there's a lot of positive catalysts for Finance of America companies. On the downside, there is, so while they were struggling and surviving in the bad years, they issued some convertible debt. So what you see for the float is not the fully diluted float. And when they acquired the number 2 position in the market, they gave them non-voting LLC shares. So the total float, I think the market cap might be misleading. I think it's more closer to a $500 million market cap if you look at the total float from the convertible debt and from the LLC. But if you're talking about a market leader for something that has enormous secular tailwinds, on Substack, I have a video where I put in a spreadsheet for what I think their earnings are going to be. And I think it's still aggressively undervalued. I think the returns from Finance of America company could beat Jackson Financial. Jackson Financial is much more predictable. I think it's a 5x in 5 years. I think Finance of America can do better than that. And I think Abacus Life, if everything goes well for them, I don't even say if everything goes well, if 1 out of 4 of these things that they're trying and experimenting on goes well, I think it'll be much more aggressive returns than Finance of America companies. But all 3 of them are fantastic, and they're my 3 silver tsunami stocks for how to maneuver, especially with this world with, tariffs and Trump and uncertainties. The $75 trillion of assets of the baby boomers, you're talking about, okay, he's going to make a trade deal with Japan. Well, $75 trillion of baby boomer assets is bigger than the entire stock market of Japan and I think the EU combined. So why are you worried about all these tariff negotiations? What's going to happen to all these trade deals when just the wealth management industry of the baby boomers is bigger than all of these potential trade deals and all the tariff concerns and all that stuff combined? It's a pretty insulated and interesting situation.
Yeah, tend to agree there. And with FOA, you said there's a disruptor, not a disruptor, but someone's coming for their market share. Is it aggressive pricing? Is it the incentives that are really doing them in terms of their ability to take market share? Are they offering financial advisors the best fees like Jackson is?
Yeah. So Finance of America companies, I think they're primarily focused on direct marketing. So there are, for example, some fintech companies that are trying to get into reverse mortgages. But this is a world where you have to get in front of a 70-year-old widow. So how do you get in front of a 70-year-old widow who needs this service? And so Finance of America companies, if you go to their website and check out their marketing materials, you'll just see, hunky Tom Selleck on there. That's how they're trying to get in front of a 70-year-old widow, is by getting in front of them with a traditional marketing approach and using traditional methods to get in front of their target market. Now, maybe 20 years from now, a 70-year-old widow will be much more online, right? Maybe 20 years from now, hold on, Finance of America. Maybe Tom Selleck's getting too expensive. So
they replaced it. He was on there. I did see him a while ago.
He was on there. Maybe now they're targeting the Hispanic community more. Yeah. We're a nation of immigrants now. But yeah, he's still on a big chunk. Maybe he's getting too expensive. I don't know. But yeah, the idea is, how do you get in front of a 70-year-old widow today? How do you get in front of a senior citizen? And I have no doubt that 20 years from now, the answer is going to be fintech, and people will be doing this through SoFi or through whatever financial app they're doing. They might do it through like rocket companies on their phone. There's going to be disruption coming. Right now, I think that the 70-year-olds are still watching television. They're still watching Law and Order. They're still getting advertised to in a more traditional way. So we're living in a period of great change. I wouldn't be so certain that this company is going to be around forever if they don't change the way they market. But I think for right now, the way you get in front of senior citizens is still a lot more traditional. But in the meantime, even if they stopped selling new policies, if all you had was this previous customers they've already locked in and the residuals they earn, the spread that they earn from their existing mortgages, then the company's still undervalued just on that. So if they're having an operating income from selling new policies now and they still have good market share, to me, that's just gravy, because the $27 billion book of business they have and the spread that they can make on that, they could do reasonably well just on that going forward. But yeah, I don't have the best background in marketing. I don't know what the best way to reach the 70-year-old baby boomer cohort is, but I know it's going to be a very competitive marketplace. And a lot of financial firms are getting more aggressive with reverse mortgages because they know how important it is and how big of a market it's going to be. So it's definitely a juicy place to be. And again, a lot of the companies that do it, it's just one of their many offerings, which then you wonder, okay, like how much are they prioritizing it? How good of a job are they going to do? But the other thing is, if you want to invest in it directly, how much exposure do you get to it as a thing? Whereas Finance of America companies, it's still the market leader, although they have lost some market share, and it's a pure 100% reverse mortgage company. So I like it a lot.
This is one I am definitely going to, forgive me for praying for a slight pullback, but yeah, I'd be interested in. Whoa, wait. It's I don't know if you've seen the meme of when the stock price goes down a lot and then it goes up slightly, the guy going like, oh, like he's celebrating.
Yeah, where it's the guy with the champagne and he ends up being in third place. Like the guy celebrating the hardest is in third place.
Yeah. Well, in this case, I'm trying to blow it down a little bit so maybe I can accumulate some shares. But yeah, this is one I'm going to be looking into a lot more closely, and this conversation has expanded my interest in the company for sure. And this is one that the subscribers in CM that also subscribe to yourself have been pushing me to kind of just also talk to you about, because they're like, hey, you like Jackson, he likes Jackson. What about FOA? There's this company FOA. Have him on. Talk to him about FOA. And no, I've really enjoyed at least this introduction to the company. I wanted to give you some time if you wanted to discuss the commodities, because you said you wanted to, or if you would like.
Yeah. So there's a lot of people that write about undervalued small cap stocks. I'm not totally unique. I think because of my background as a financial advisor covering these three silver tsunami stocks, that might be my unique contribution. But I'm into some of the same stuff that everybody else is. So for example, the platinum mining companies. I've got some exposure to Sibanye-Stillwater. And the thesis on platinum mining, and this is something that I didn't pick up on until recently, and I was kind of amazed that up to a few years ago, before I had done any individual research on it, I had just kind of, I guess, through the soft power of the narrative makers, I just assumed that we were all going to be driving electric vehicles in 10 years. And then as you get into studying stocks and you get into researching individual companies, you get into more niche stuff, you listen to mining companies in particular, and they said, look, we're not going to be driving electric vehicles in 10 years. There's just not enough nickel mining. It's not going to happen. If you're using this technology, we are not having, 2035 all electric vehicles. It is not happening. So internal combustion is going to be around for a lot more decades than I had thought, before I had done my own digging in it. And internal combustion engines, we use catalytic converters that have platinum in it. And platinum is a very interesting metal because everything heavier in the periodic table than iron came to the US, or came to the world, came to planet Earth because an asteroid hit us, right? So everything on the periodic table heavier than iron used to be an asteroid. Well, it turns out that the asteroid with the most platinum group metals just hit South Africa. So 80% of platinum group metals are mined in South Africa. That's just where the asteroid hit. That's just where it is. Mm-hmm. And platinum group metals, they're used as catalysts and catalytic converters. And the price of these precious metals, this platinum group metals, has crashed because with rising interest rates, people just aren't buying cars like they used to. So if you look at the fleet age, the fleet age is going up and up and up. But and the person who brought this to everyone's attention first was a guy named Trader Ferg. I don't know if you've ever interviewed him, but he's always fun to listen to. But he was the first person I ever heard that said, wait a minute, hybrid vehicles, which are going to be the market winner for, at least the next 10, 15, 20 years, use 15% more platinum group metals than a traditional internal combustion vehicle, right? So because the metals do not exist for us, the metal and the grid capacity. So even before artificial intelligence, even before we realized, holy crap, we do not have enough electricity generation, we do not have enough of a power grid. Electric vehicles, we can't get on electric vehicles within the next 2 decades. It's just not even remotely possible. Between power generation, between the grid competing with artificial intelligence, between the metals that goes into the batteries, it's not possible. So there's probably 10 or 20 years where the market is going to decide Toyota was right, hybrid vehicles are the way to go. Because hybrid vehicles have a cold start, the hybrid vehicles require 15% more platinum group metals than a traditional internal combustion. So the demand for platinum group metals is going to go up and not down. And again, I think the first person I ever heard discuss it that way was Trader Ferg. And all the platinum group mining companies are in South Africa. There's 3 big ones. There's Sibanye, Stillwater, Impala Platinum, and Anglo American. And their prices are in the dumpster because I think the marketplace generally said, okay, platinum is for internal combustion. Internal combustion is going away. We're all going to be in electric vehicles. So the market is dead. And so the prices of the platinum group miners, they're all in the toilet. And within the next 2, 3, 4 years, at some point, if you have some interest rate relief, so if you look at the fleet age of cars in the US, the fleet age of cars in the US has gone from about 11 years old to 13 years old. So for the last couple of years, people are not buying new cars. So if we get to a world where, people around the world are buying cars again because interest rates are a little lower, maybe we're in an economic boom, and you get some tightness in the platinum group metals market. Platinum group metals, if you compare it with something like gold, much, much more gold is mined annually than platinum group metals. Platinum group metals are this really tiny niche metal. And gold, because it's used as a monetary metal, most gold ever mined is still in storage above ground. So the new amount of gold mined every year is a small amount compared to the stock. Platinum group metals, what's mined every year is used every year. Mining capacity is very hard to increase. And if you get some sort of a squeeze, some sort of a price squeeze on the platinum group metals, for most of human history, platinum is traded at a premium to gold, not a discount. I don't know if that's good because you have central bank buying demand for gold because, and again, I think this is due to the BRICS looking for an alternative to the dollar, but central banks all over the world are turning to gold. And I think that trend is a multi-year trend. I think it's at least a decade of gold prices rising. I don't know if platinum will ever go above the price of gold again, but it easily has room to double or triple. I mean, you could easily see $3,000 platinum. And especially because silver has always been thought of as the poor man's gold. So in past gold cycles, the price of gold moves first. And then once the retail investor finally starts getting it in their head that they want to own physical precious metals, what usually happens is silver has a much more explosive and much more violent squeeze as being the poor man's gold. But when you have Costco selling troy ounces of platinum, and you see gold now at $3,300 an ounce and platinum at $1,000 an ounce, I think odds are really good that in this cycle, platinum becomes the poor man's gold. And the market for platinum is so small that even what Costco sells could move the market, right? If somebody says, okay, if gold's $4,000 an ounce, instead of buying 1 ounce of gold, I'll buy 4 ounces of platinum, that could have an enormous effect on this market. So the odds that gold becomes, $4,000, $5,000, and platinum goes to $2,000, $3,000, $4,000, I think is really, really good. So this is one of those areas where it's been painful for the last couple of years, just like almost everything else has been painful for the last couple of years. But the explosive upside for any of the platinum miners is pretty aggressive. And again, it comes from, there seemed to be this consensus that we're all going to be driving electric vehicles. And the nickel miners say that's not going to happen. It's not possible. So it looks like hybrids are going to win. And hybrids use more catalytic converters. They use more platinum group metals than internal combustion. So the demand is going to be higher, not lower. And a lot of people are not expecting that. So my favorite of the three is Sibanye-Stillwater, but you could pick any of them because I think it's going to be a platinum group metal story generally.
Where are they located, that miner?
Oh, so all three of the big ones are in South Africa because that's where the asteroid hit that has the platinum group metals, right?
They have to be there.
You get a little bit of palladium out of Canada. You get a big chunk of palladium out of Russia. So Nornickel, the big nickel miner in Russia, has a pretty good amount of palladium. A few years ago, the palladium price was $2,000 an ounce and the platinum price was $1,000 an ounce. And the increased nickel production out of Russia has brought palladium down to $1,000 an ounce and platinum to $1,000 an ounce. So there's 3 platinum group metals that are big in catalytic converters: platinum, palladium, and rhodium. Now, chemists have figured out how to substitute between platinum and palladium. So those prices coming together for platinum and palladium make sense. Rhodium still has no substitute. And if you pull up a long-term rhodium chart, I don't know if you have screen sharing for me, but I can try and find one if you like.
Yes, if you look at the bottom of your screen, there should be an option to share screen.
Okay, let me first find my rhodium price chart, and then I'll do a share screen. So okay, so at the bottom, there is a share screen button.
It should say present, I believe.
Present.
It'll look a little different from mine because I'm the host.
Share a screen. Share screen. This one. Okay.
It'll give me a preview before you do it, so don't worry, and then you just let me know.
Okay.
Yeah.
So you have a preview on the rhodium price?
Yeah, right there.
Okay, so this is the rhodium price, which has been flat around $4,700 an ounce, and since has had this recent tick ups, this little recent activity. Check out what happens when I zoom out. So rhodium, this is the platinum group metal that the chemists have not figured out a substitute for. And in the last, when interest rates were 0 coming out of COVID and people were moving to the suburbs and they were buying new cars, rhodium prices went to $28,000 an ounce. And they're currently sitting down here at $5,000 an ounce. The next time that rhodium has a price squeeze, it would not be unfeasible for rhodium prices to hit $40,000 or $60,000 an ounce, because even though it's a tiny amount, even though it's a few grams, it is an essential and not substitutable part of catalytic converters for cars. Hybrids need even more platinum group metals than traditional internal combustion. Hybrids are going to take market share, and there's currently no substitute for rhodium. So whatever the price is, you have to pay it. And rhodium is, depending on the platinum group miner, it's only about 6 or 7% of the platinum group metals that are mined. So most of what's being mined out of South Africa is platinum with a little bit of palladium. Most of what's being mined out of Russia is palladium. But rhodium really comes in large concentration from just one part of South Africa. And Sibanye-Stillwater, compared to their peers, is higher than the rest at about 9% rhodium production. So if rhodium really goes to the moon because it's not substitutable for palladium or platinum, then Sibanye-Stillwater is the best of the 3. So this is This is just an exciting, I wouldn't make this my whole portfolio, but if you look at the value of Sibanye-Stillwater, and Sibanye-Stillwater has other things going on with it too. So for example, they started out as a gold mining company. They still have legacy gold mines that make about 600,000 ounces of gold a year. And at the peak, that was 800,000. So their cost of mining gold is about $2,100 an ounce, which when gold was $1,900 an ounce, they shut in certain mine shafts. But if the gold price stays high enough, they have all these legacy gold mines where, you know, the marginal cost of production was $2,100, $2,500 an ounce. So Sibanye-Stillwater, it's not unfeasible that if the price of gold stays high enough for long enough with these legacy gold mines reopening old shafts, they could get up to, you know, 800,000 ounces of gold mined again in a year. I don't know if that'll happen. South Africa has energy problems. So the South African mining countries, you see them, the mining companies, you see them building solar panels and things like that. South Africa has electricity generation problems. But one thing that's nice about Sibanye-Stillwater compared to Anglo American and Impala Platinum is Sibanye-Stillwater does have a mine in, I think it's Montana. So they have a US domiciled mine, but just like the Canadian production, it's mostly palladium and you're competing with the Russians with Nornickel. So the big reason to own Sibanye-Stillwater is the rhodium percentage, which is 9% compared to the competitors at like 6.5%, 7%. And the next time there's a rhodium squeeze, you know, this thing can go crazy into the moon. So again, that's the main thesis is for 10 or 20 years, hybrids are going to win. Hybrids need more platinum group metals. And by the way, even in the third world, the regulators don't skimp. The regulators don't give you a pass on catalytic converters because in poor countries, population density is so high. If you are not cleaning your exhaust, you know, everybody dies from the smog. So even in poor countries like India, their rules on catalytic converters are pretty strict, right? If you're selling new cars in India, you got to have a catalytic converter on there. So normally you think, oh, this is a rich country problem. This is what Europe and the US are doing. Poor countries, their population density is so high, they're not skimping on catalytic converters. So I think that's an interesting part of it. How do I stop sharing?
I can take it out here like that.
So that's one aspect. So I've got a bunch of write-ups on Sibanye-Stillwater and the Platinum Group miners. And then another one that's big in the value degen space is Offshore. And Offshore has been just, the stock prices have been brutalized. But, and I just wrote an article about it, I think Monday, because the big three offshore companies all announced earnings. And so these oil rigs, these drill ships get leased out by the major oil companies. And offshore, so we had this shale oil revolution where, you know, it's like a manufacturing process. You fracture the shale, you know what's going to come out of it. But the thing about that is shale oil is light. It's light, sweet crude. And that's good for making some things, but it's not good for making everything. If you want heavy sour crude, one of the places you can get that is Canadian tar sands. You can get it from Venezuela. But one of the other places to get heavy crude is offshore. And offshore, so what got me into the offshore drill ship industry in the first place is as shale goes on, it becomes more and more expensive. So the break-evens for shale, even in the Permian, some people put it between $60, $65. There are offshore discoveries where the break-even is $20, $25 a barrel, $35 a barrel. The vast majority of offshore discoveries, the break-even is below $50 a barrel. So if you're an oil super major, you know, do you want to be playing around with shale and have a $60 a barrel break even, or do you want to go offshore and have a $45, $50 a barrel break even? Yeah. And the difference is the upfront cost offshore is higher, right? Building it out in the first place is higher. Where upfront, you know, shale has a lot more ongoing cost. You're constantly fracking, you're constantly drilling more. Whereas offshore, you set something in place and then it's pumping for like 10, 20, 30, 40 years. So the upfront cost is higher. But as people are waking up to the fact that the world is going to be on fossil fuels for a lot longer than I think people thought they were going to be, I think the offshore market is very exciting. And one of the three companies, Valaris, just announced a new contract where the day rates to rent out these drill ships were $480,000 a day. So there's these drill ships. So again, it's supply and demand for price. A modern drill ship, which it's more than $1 billion to build one of these things. And that's if the shipyard will even accept your order to build it. So in 2014, the oil price crashed. And when the oil price crashed, a lot of the offshore drilling companies went through bankruptcy. So Valaris went through bankruptcy, Noble went through bankruptcy, wiped out all the debt, wiped out all the shareholders. And now they reemerge. And they have this equipment. Most of this equipment, that most of these drill ships were built in the years before. So we had high oil prices, from all throughout, from the global financial crisis to 2014, oil prices were quite high. But after 2014, when the shale revolution really picked up, it really crashed oil prices pretty low. And the offshore drilling companies, only one of them didn't go bankrupt, which is Transocean, and which means they still have debt associated with them. But Valaris and Noble have very little debt with them because they went through bankruptcy. They have these drill ships which cost over $1 billion to build. And it would take at least 3 or 4 years in the shipyard to build one. And the shipyards are all booked out for a couple years. So from the supply side, there's going to be no new deep water drill ships built within the next 5 years, because somebody has to book a slot at a shipyard, which is already booked out 2 years in advance, and then it takes 3 years to build one. So the supply is fixed. All the drill ships that there are is all the drill ships that there are. Meanwhile, you keep on getting these offshore discoveries in Africa and these offshore discoveries in Guyana. So there's the demand for offshore. Since 2014, it's been very suppressed with oil prices falling. I think there's a good chance that the demand for offshore is going to be coming back. Oil prices have been a little weak. We've been in supply destruction territory. But let me see if I can find, I don't know if I'll be able to find this graph so handily. Actually, no, if your viewers will bear with me for just one moment, I should be able to find this graph. So because I put it in my recent write-up on the offshore market. And this research comes from Rystad, who is one of the, anyway, their research is pointed to a lot. Let me go to, so this is a graph on, okay.
Let me know once you share it and I'll bring up your screen.
Present, share screen. Yeah, let me share that. So this is a forecast for offshore capital expenditure from the research firm Rystad. So you see that, so global deepwater greenfield investments by approval year, ever since 2014, the amount of money being spent offshore to develop new projects has been in the range of $40 to $60 billion a year. But coming into 2026 and 2027, it's projected to double. The major oil companies, Shell, BP, Petrobras, they're about to start spending $100 billion a year developing offshore assets as shale matures. And then on the left half of this is break-evens. And you see 90% of offshore projects have break-evens that are below $45 to $50 a barrel. So as shale costs $65 a barrel to develop new shale, well, why not go to where it's, $25, $30 a barrel to develop new offshore oil? And that's why people are looking at Guyana, people are looking at US Gulf of Mexico, people are looking at offshore Nairobi. So again, you can't get a new drill ship in under 5 years. If you said, I have $2 billion on a new drill ship, that's not going to arrive until at least 2030. And nobody has $2 billion that says, I'll buy a new drill ship at any price. So this equipment that these three major companies have, Noble, Valaris, Transocean, that equipment is scarce. There's no new deep water offshore drill ships coming online within the next 5 years. And you're hitting this world where in 2026, 2027, offshore spending is about to double. And so those drill ships, those scarce drill ships, are going to get booked out at expensive rates. And the contracts for this work are negotiated 9 months in advance. So what you just saw, there were three new contracts announced. So Noble announced 2 contracts with Shell and 2 with Total Energies. And Valaris announced the new contract offshore Nairobi. The ones with Noble are hard to estimate because they have performance-based riders. So they're somewhere between $415,000 a day and $498,000 a day. We don't really know what the final price is going to be until years later when we see what the performance-based part was. But Noble thinks that they can meet their performance targets. So the day rates on this equipment, it's already over $400,000 a day. let me just, this is my paywalled write-up. So in 2021, when I first bought shares of Transocean, these drill ships were being leased out for about $200,000 a day. And these day rates have been marching steadily. Now, the stock prices collapsed because there was some weakness in day rates, right? The day rates stopped their march upward and started falling from $450,000 a day to, there were some contracts for $300,000 a day. So this trend, Transocean stock price went from $8 to $2 just on this little dip, which is completely unjustified because these companies have backlogs, right? These contracts are long-term. Transocean's fleet is mostly booked out for the next 2 years at some of these older day rates, but there was some weakness. But if this is correct, right, if Rystad's research is correct, if we're hitting a world where offshore capex is about to double, then those day rates are going to be quite attractive, and these companies are going to print just massive amounts of cash. If you look at the market cap of the companies compared with the assets that they have and what they're going to be earning when, if offshore capex is about to double, what are the day rates of these ships going to be? This has got an enormous upside volatility potential. And what's interesting about it is Transocean went from $2 to $8, then back down to $2 again. It had this amazing roller coaster. And the whole time, people like me were writing about, Transocean's an amazing company and it's cheap at $5. And then it crashes back down to $2 again. And the market overreaction has been so extreme. And the thesis that, look, shale oil is getting... So I'm not a doomer. I'm not saying that shale oil is in decline, but is getting mature even because of mergers and acquisitions. So you saw all the mergers in the shale patch when some of the big companies bought out other companies there. Those mergers and acquisitions, what they do is they'll take a company that has 5 years of inventory and they'll cut the drilling program so they have 20 years of inventory. So you're going to see declines in the shale patch, not because it's a law of geology, because it has to be, but because of the mergers and acquisitions. The larger company acquires it and then wants their inventory not to last 5 years, but to last 20 years. So they cut the drilling programs. So shale volumes for oil in the US, for one thing, its high cost barrels should be declining. I think the smart money is in offshore capex increasing, drilling programs increasing in the Gulf of Mexico. Sorry, supposed to call it the Gulf of America now. So what's funny is on earnings calls, the companies are calling it the American Gulf, because they don't want to offend Mexico by calling it the Gulf of America. They don't want to offend Trump by calling it the Gulf of Mexico. So the political thing to do for, I can't remember if it was Noble or Valaris, they call it the American Gulf so that they don't offend anybody. Anyway, if this research is correct, right, if offshore drilling capex is about to double and you can't get a new drill ship within 5 years if you wanted one, then all three of these companies, Noble, Valaris, and Transocean, are just incredibly undervalued.
And you said for Valaris and Noble, the debt question is not an issue. Do you prefer those two? Because me not knowing anything, you telling me that, I go, oh, I'd probably just rather play this with Valaris or Noble. So
there are a lot of strong opinions, and if you prefer one or the other, half of the investing community is going to get mad at you.
Really?
Yeah, and people have really passionate opinions. I think all three are good. And one of the things I look for is I look for large shareholders that are knowledgeable, that are guiding management. And so Noble has a chunk of the company owned by the founding family of Maersk. So Noble has an anchor shareholder. Valaris, John Fredrickson, the Scandinavian shipping tycoon, bought 10% of Valaris. So Valaris has a large, knowledgeable anchoring shareholder. Mm-hmm. And Transocean has a guy named Friedrich Mohn who owns about 10% of the company. So each of the companies have the same incentive alignment in having a knowledgeable anchoring shareholder to talk to management and tell management not to do something stupid. That wasn't always true. So John Fredrickson only recently bought into Valaris. So at the time, I liked Transocean better than Valaris because I had more confidence that they were aligned with shareholders. But now in that way, they're all the same, right? So a lot of the things that I used to think were different about them have become more similar. Transocean has the leverage. They still have their old debt that didn't get wiped away in bankruptcy. But Transocean is also the technology leader. Transocean has the 2 8th generation ships. And the 8th generation ships, they have a higher hook load capacity. They can carry heavier things. In the American Gulf, So you remember the Deepwater Horizon blowout.
Yes.
In the American Gulf, you need the 20,000 PSI equipment, and the 20,000 PSI equipment can only be handled by the heavy hookload ships. Noble, on their 2 recent contracts, just agreed to spend $60 million per ship, upgrading them to the higher hookload. Transocean already has 9 ships, and it used to be so they used to have the 2 out of the 3 8th gen and 8 out of the 12 7th gen plus with the highest hookload. So Transocean was the clear and away technology leader. And now Noble's spending $120 to $140 million trying to catch up with 2 of their ships. So Transocean is the technology leader. Debt can be a bad thing, but it also can be a good thing if the stock price is leveraged, right? So if you are more degenerate and you want that financial leverage and operating leverage, Transocean's attractive in that way. But if you so Valaris is already free cash flowing and already doing share buybacks. So if you like the no debt means you're already doing share buybacks, but debt means you have financial leverage and the stock price could swing higher. So it's not really clear. I think there's no wrong answers. I think all 3 of the companies are good. I liked Transocean originally, but I also put Noble in my wife's Roth IRA because Noble focuses on dividends as opposed to share buybacks. So if you've got it in a Roth IRA, you're not paying dividend taxes. So I've got dividend reinvestment on in my wife's Roth IRA, and then Noble is just as good as Valaris because dividends are the same as buybacks at that point. There's really no wrong answer between the 3. I like to go with proven management, and Transocean surviving the oil price crash from 2014 onwards. Transocean has incredible management. It's absolutely incredible. Not everybody believes that because they have done some dilution to acquire some stranded ships, but they've only done that when the ships were the highest specification, the highest technology to maintain their technology leadership. And also, if you look at recent behavior, both Valaris and Noble had about 1 year booked in advance, and Transocean had 2 years booked in advance. So because the new drilling programs are coming in 2026, they get negotiated 9 months in advance. These new contracts are going to start being announced probably this summer. Probably this summer, you're going to have just news announcement after news announcement after news announcement of new contracts getting signed by these 3 drillers. There's going to be some huge euphoria in the marketplace. People are going to be like, okay, we're so back. But in the meantime, you're going to have some white space. So I think I have am I still sharing? Let me see here.
Yes.
So this is from Noble. And so their new contract that was $415,000 a day, it starts here. And the old contract ends here. So now here's Noble. They're just going to sit on their thumb for 18 months with this ship unless they can find some short-term work in between. And these ships are very expensive to maintain. So any white space on their order book is pretty devastating. You're talking about tens of thousands of dollars a day to maintain these things without not earning any money. Noble and Valaris have white space. And so if you look at just as far as which management team was the best, so this was the order book coming into this time period in 2024 and 2025 when things were bad. Transocean had the most completely booked out fleet through the end of 2026. And Noble and Valaris are likely to suffer some white space in the meantime. So this is not a lot of money. It's not devastating to the investment thesis. It's just me saying that Transocean's management has consistently been better, right? They know when it's time to lock in a contract for 2 years. They know when it's time to lock in a contract for 1 year. They know when it's time to lock in a contract for 4 or 5 years. So I think Transocean has the better management team, but that's hotly debated and people will write mean and nasty things in the comments, and that's fine. I still say all 3 of these companies are good. Noble, Valaris, Transocean, you could buy any of them. And then there's a Seadrill, which is smaller and is almost certainly going to be somebody's acquisition target. So if you want a short-term pump and you don't mind paying taxes on selling the position early, Seadrill is probably going to turn into shares of Transocean or Valaris, or who knows, maybe even Noble. So Noble had done an acquisition. So this entire industry is consolidating. They want to become an oligopoly and have more market power. Noble bought Diamond Offshore. So Noble had recently done an acquisition. And on the last earnings call, they announced, hey, it's digested. We've got all our synergies. We're done handling the digestion of that acquisition. Seadrill, the CEO of Seadrill, announced at a conference, at the right price, we're happy to be acquired. So he's shopping it around. He's looking to sell the company. But Valaris has a clean balance sheet and could buy them partially with cash, where Transocean has debt. So Transocean would have to do a dilutive. They'd have to do it with stock. And Transocean's stock price is too low to do it with stock. So I think everybody knows Seadrill is going to be acquired. We just don't know by who or when. And so that's this kind of the state of the market, is that Valaris and Noble have more white space. I think Transocean has the best management team. Transocean has debt. Noble and Valaris, I think Noble might have a little bit of debt from the acquisition. I don't think Valaris has any. Noble does dividends. Valaris only does share buybacks. And on this last quarter, so Valaris did not do any share buyback announcement this last quarter, and people are saying, aha, does this mean they're holding cash to buy Seadrill? And maybe. We don't know who's going to buy Seadrill. But anyway, that's the current state of the market.
And Seadrill, how's their balance sheet looking like?
I don't know off the top of my head. I do kind of know. They have a tiny bit of debt, but they're mostly debt free. And I can't remember if the debt is convertible, but I think the conversation was that whatever acquisition took place would probably have to retire their outstanding convertible debt. I'd have to double check. My best understanding is a small amount of debt, but it's convertible and would be wiped out in the acquisition.
And for Valaris, they have now some debt, right? It's like $1 billion, but the net debt position is still quite small relative to everyone else.
Yeah. Yeah. And Noble acquired some debt when they took on Diamond Offshore. I don't remember how Valaris got that, because they were debt free after bankruptcy. So I don't know how they acquired that debt.
Maybe they used it for buybacks.
Yeah, which is reasonable, but we'll have to see. Yeah.
I mean, because if you're not really using capital to buy new equipment, because there's no point, or it's, I don't know. Are they discussing, still having some orders and they're waiting for 2030, or are they more just like, we have our fleet, we're good?
Right now, nobody's even talking about ordering a new drill ship.
I like what you said. Nobody's talking about.
Yeah, because a new drill ship would cost, and it would be $1 billion for the older technology. If you're talking about the highest specification, the 8th gen, and why would you build anything other? Like if you're gonna pay up, might as well buy the highest specification one. A new 8th gen drill ship would probably cost between 1.2 and 1.5 billion. And you look at the market cap of these companies versus how many ships they already have, and it just doesn't make sense. And the day rates would have to be, and people have crunched the numbers on these, but day rates would have to be well over $700,000 or $800,000 a day before that made any financial sense at all. Now, if you look at Transocean's 2 8th gen ships, so they locked in an 8th gen ship at $630,000 a day. So the day rates on the highest specification ships, feasibly next year, they could be $700,000, $800,000 a day for new contracts. But even if a company wanted to, for one thing, I think the shareholders would immediately punish any company that did that, tried to order one. And the other thing is, it still would be 5 years out. It still wouldn't affect the supply and demand for the next 5 years, because the shipyards are already full building other things. One other aspect of this thesis is global shipyard capacity in the last 10 years has been cut in half. So this is going to be true whatever kind of shipping you get into. If you're into dry bulk, if you're into container ships or oil tankers, global shipyard capacity in the last 10 or 20 years has been cut in half. You just have less capacity to build new ships. And in 2014, when the oil price crashed, the drill ship companies burned the shipyards. So as the drill ship companies went out of business and declared bankruptcies, some of the shipyards went bankrupt. So the shipyards have said, where before we would build a drill ship with 30% down payment, now we want a 60% down payment, right? So you've got the shipyards aren't even interested in a new drill ship order. The terms that they're putting on the drill ship companies to build a new one, who wants to put 60% down on $1.2 billion? Nobody wants to do that. For something that's going to be 3 years to build, and it's going to start building in 2 years. So like a 5-year minimum, 60% down, $1.2 billion. The safest thing right now is that new supply is not coming, except for there are some ships that are called cold stacked, right? So these are ships that were built in the year 2005, and they've been floating around in the middle of the ocean for the last 5, 6, 7 years. And to reactivate them, to go in there, clean out all the rust and replace a bunch of parts, would cost upwards of $150 million to reactivate these cold stack ships. A lot of companies, so the companies that went through bankruptcy, the bankruptcy judges told them, yeah, these cold stack ships, that's going to the scrapyard. So Valaris and Noble do not have these cold stack ships. Transocean and Seadrill have, I think Seadrill has 3, I think Transocean has 6. So they have capacity that could come online from reactivating these ships, but it's the real negative Nancy's say that these ships will never be back online. After 7 years floating, there is too much rust. It's never coming back. This is going to the shipyard. That's not what Transocean's management team says, and I kind of trust Transocean's management team. So I could be wrong. The real negative Nancy's say that these are buckets of rust and they're going to the scrapyard. They're never coming back. If they do come back, Transocean can add 6 ships to the fleet for about $150 million each. And if they're not coming back, then they're going to get scrapped for scrap metal for $30 million each. But anyway, that's really the only source of new supply within the next 5 years. And none of these companies are talking about placing a new order. And if they did start talking about placing a new order, I think their stock price would get punished pretty hard.
Interesting. So, and then the actual oil majors, they're not interested in buying a fleet because they have the balance sheets for this and they could wait, but and in the meantime utilize these guys. But
so this is where you get into diseconomies of scope, where if a company tries to do too much, they get bad at what they do. Oil companies will sometimes own a jackup, and Valaris sold. So Valaris owns the deepwater drill ships. There's also something called a jackup, which is a shallow water platform. So you've probably seen an oil platform out in the so you've seen pictures of an oil platform. That's a shallow water solution. Those are referred to as jackups. Valaris just sold a jackup to an oil company for, I think, $108 million. And this is something that was held for book value. I think value on the book was something like 10 or I have the number wrong, but it was held for book value at a tiny fraction of what it sold it for, because an oil company will buy a jackup. The maintenance and the technology for operating a jackup are less of a hurdle that an oil company would own a jackup. But the oil companies have no desire to do these very high specification, very high technology, deep water or harsh environment drill ships. So I with my limited knowledge of the industry, I would say you're not likely. So because these companies are so cheap, it's a reasonable question. Why wouldn't Exxon or Shell or Petrobras just buy Valaris? I mean, $3 billion, they could sneeze $3 billion, right? They could blow their nose and find $3 billion. Why not just buy a whole fleet of these things and control them? I think it gets into diseconomies of scope. It's just too different of a business. They don't need to get into that giant pile of mess.
And is it, in the grand scheme of things, it's not a big percentage of the cost of operations, right? Or is it huge?
So the drill ships are used for exploring. And so the oil majors will hire these companies to drill exploration wells, and then when they're finally brought into production, they're used to deploy this more permanent production equipment. But once it's pumping for like 20 or 30 years, the drill ships have moved on to their next project. So I think that's probably why anyway. I think it really just comes into diseconomies of scope. It's just a part of a business that the oil super majors don't find to be critical to their business. I think it's super cheap. Maybe it would be a smart thing, but you do find in the merger and acquisition literature, diseconomies of scope are a big deal. People are very worried about, you try and juggle too many balls and you get bad at everything. So I think it just doesn't fit in their business model.
Okay. These ones are interesting. I think Seadrill looks pretty interesting off of just like the quick glance. I get that, yeah, they're probably like the one that will get acquired away from you, but hey, maybe that's fine. I had a few members who were trying to push offshore drilling to me, and this conversation was actually the first verbal conversation I've had, at least with anyone on this idea, and it is interesting. So with the increasing capex coming online in 2027, estimated, and the current day rates, I saw they were hitting 400,000 or so. You know, what's the implication there that they could get to some order of magnitude greater than that? The debt, again, this is like very surface level because I'm just like starting to look at this. The debt might push me away from Transocean. I get that you're saying the management team and the booking. My question actually that I had, if you knew, are they getting that consistent booking because they're underpricing? Is that maybe why?
No, Transocean is known to hold the line and push for the higher pricing. So they're known for it. Whereas Valaris, when day rates were $200,000 a day, they engaged in contracts that were too long. So Transocean has really been good about when day rates are low to do short-term contracts and when day rates are high to do longer-term contracts. But again, I'm not. So I have DGen in the name. So if people follow me on a trade, it's kind of like, hey, you know, you followed somebody who is a degenerate gambler. But if you look at where Transocean's debt is trading, Transocean's debt is trading at, I think, 97 cents on the dollar. Right? The bond market thinks that Transocean is completely fine as far as bankruptcy risk is concerned. I mean, they do have debt, but they have enormous assets to pair against that debt. And their backlog now of, I think they have a $8 billion backlog of work, but it's spread out over the next 2 years. What's really going to change the stock price of these companies is when they start locking in. And what was really interesting about Noble's 2 contracts. So this is why I think right now the stock prices offshore are in the dumpster. Noble just signed 2 contracts with Shell that were for 4 years with 4 one-year additional options. So Shell just locked up 2 rigs for upwards of 8 years. When you see prices rising for the day rates, plus the length of the contract rising, that means the oil majors know these prices are going up and it's time to lock things in for as long as they possibly can. I think so. I was early on offshore, but I think that the time to strike is getting pretty hot right here. If you see this summer a lot more really long-term contracts, 3, 4, 5-year contracts start getting signed at high day rates above $400,000 a day, the backlogs of these companies and their predictable earnings for the years going forward are going to be so enormous. I don't think they're going to stay as mispriced as they are. So I think it's I was early. I think I bought Transocean for $2.52 a share in like 2022 or 2021. So I'll eat my humble pie. I was early, but I feel like the time to strike is probably getting pretty close.
And I just checked real quick, just a quick glance. It appears as though Transocean has been deleveraging. There's been meaningful movement in that direction. I see that they had back before COVID close to $9 billion in debt. They're sitting at 5.9 in long-term debt. And then let me check current portion. It's about $1 billion right now in the current portion, and they have. Oh, sorry, not $1 billion. Apologies, that's. Went backwards there. Current portion 712 with 263 million in current cash with 551 in receivables.
Yeah. So Transocean, because they do equipment leasing, some of that is amortizing. So their debt pay down has been automatic because they have amortizing debt. And if you take that into account, Transocean, if you look at their backlog and the day rates, they already have contracts to reach free cash flow positive status. And if you consider paying down debt to be, adding shareholder value, which, case by case it is, case by case it isn't, arguably they're already free cash flow positive if you consider paying down this debt to be the prudent thing for Transocean to do to be delivering anyway. So I think they're in a much, much safer position than a lot of people think they are. I think it's, as far as which one is mispriced, I think it's more mispriced than the rest. But again, with Valaris, you have the share buybacks. With the Noble, you can have dividends, which you can, in your Roth IRA, do, share reinvestment, and it's as good as share buybacks. So it's just a matter of who's returning capital to shareholders now versus who's eventually going to be able to return more capital to shareholders. I don't think there's a bad pick of any of the offshore drillers. I think they're all fantastic. And with the sell-off, all 3 of them sold off together, and all 3 of them sold off almost as much. So having no debt didn't save you from the share price sell-off. Having the technology leadership didn't save you from it. Nothing saved you. It's such a small market, such a niche market, that when people sell it, they sell it all together. It trades as a basket, which is, I think, kind of depressing at how inefficient the marketplace is. But yeah, take your pick. They're all good companies.
Yeah. Wouldn't you say, though, the one doing the share repurchases, as far as like both tax efficiency, but acting as like a springboard, if they're able to, I just took a quick glance. I don't know if this number is right or if my data aggregator is wrong, but Valaris decreased their share count by, what is this? Let me percentage, 63% over the last 5 years. Is that true?
Yeah. So their share buybacks have been aggressive. What I didn't like originally about Valaris is they have a mix of the deep water drill ships plus jackups. And I personally, there are a lot of people that are super into the jackup market, but the jackup market, the supply and demand is not as tight as the deep water market. And those platforms are also easier to build. So where it would take you 5 years to get a new deep water drill ship, you could probably get a shipyard to build you a jackup, within 2 or 3 years and much more cheaply. And there's also a lot more cold stack jackups. So the idea that there's going to be a squeeze in the day rates of the deep water offshore, I think, is much more likely than the jackups. So, but I don't think the jackups are a terrible market. It wasn't the spot that I picked, but I'm not against anybody buying Valaris now. I just think, so Valaris, about half their fleet is jackups, and it's not a bad market. It just doesn't have as much of the supply and demand squeeze potential as the deep water market. So again, and originally I didn't choose Valaris because they didn't have that strong anchoring shareholder. Since then, John Fredrickson has come in and bought 10% of the company. So now they do have that strong anchoring shareholder. Valaris is a fine company. You could absolutely choose it if that's the spot you wanted to choose. Them not doing any increase in share buybacks last quarter leaves open the possibility they do acquire Seadrill, which, obviously depends on the price they pay, because if they just retire a bunch of stock and then they dilute themselves to buy an acquisition at a bad price, that would undo some of that. Look, I think they're all. Remember that meme? They're all good dogs, Brent. I think they're all good offshore companies. I don't hate any of them.
All right. Well, I have my homework cut out for me on these. I think the offshore trend right now, we're in an interesting conjunction because energy right now is depressed. And I think that could motivate people, like we were discussing earlier, more. When I say people, I mean oil producers, more to kind of seek out these lower break-even point opportunities. And offshore is definitely presenting that. Do you have any opinions or thoughts on onshore, or you're just strictly offshore?
So onshore, I know that I'm not going to be great on timing. So I don't like short inventory life. I like slow decline assets. I had found an onshore slow decline driller that I liked, and Carl Icahn was a major shareholder. I thought, okay, great, there's good shareholder incentive alignment. But that ended up not being the case because this company had plenty of cash flow. They had the ability to buy back stock, but instead they just paid special dividends because Carl Icahn got squeezed when his own company needed cash. So it ended up not being the shareholder incentive alignment that I thought it was, because they ended up doing bad capital allocation policy when I thought they shouldn't have. So I do like if this is another company that probably we've been talking too long, so I want to get into. Sometimes companies are cheap for a reason, and sometimes as a value degen, I run into low quality stuff, which is one of the reasons I really like Jackson Financial so much, because it's a high quality company. And it's tough to balance sometimes between what's mispriced for high quality and what's mispriced for low quality. And there are a lot of low quality onshore oil producers. But for me personally, not being confident that I'm going to nail the timing, I'm staying out of shale because the life cycles are so low. But there's a lot of there's so many spots to pick, and I've written about so many companies. Like if you are interested in if you don't mind the tax complications of a limited partnership, like Blackstone Minerals with their land ownership in East Texas has this amazing dividend, and with the with the natural gas export terminals coming online. Like I just can't imagine anybody who's comfortable with limited partnerships not wanting to just pull up the back of the truck and load up on Blackstone Minerals. I've written about, so I do own one Canadian producer, Vermilion Energy, because they are producing natural gas in Europe where the price of natural gas is obscene because of this trade embargoes with Russia. And their stock price only falls. It never goes up. It doesn't. They pay down $1 billion of debt. Their stock price goes down. They take that $1 billion, do an acquisition, increase production by 60%. Their stock price goes down. It's like no matter what they do, the stock price only goes down. And at some point, that's going to reverse. But in the meantime, it's been very painful. So I, on my Substack, I've written about a lot of oil companies. I've written about New Fortress Energy, Vermilion Energy, Blackstone Minerals. There's a lot of spots you can pick in energy, but it's you got a balance between quality and value. And I'm not always an expert at that.
I laughed because I was like, Blackstone, actually, in particular, we covered in the past. I have one for you that maybe you'd like to, if you don't know about them, maybe you do. It's one based out of Peru. Well, it's weird. So it's Peruvian assets, I believe, traded in the Canadian stock market and headquartered in Texas. Hilarious, right?
Yeah.
And the company's called Petrotal.
Petrotal. Okay, I will write. I have a Google document with my list of things to look at. Petrotal.
Definitely look into them. Just like to get you the head start and to kind of share what at least some of the things. There is a tax in Peru, so just like watch out for that and for their break even. They break it down nicely in their presentation. Their break even costs are pretty low, even including the tax that they have to pay, and that's kind of like the royalty they have to pay to the country of Peru. They have no debt. They have a good amount of cash. A lot of that cash, though, is geared for the CapEx to protect their assets from extraneous weather activities, flooding, etc. So they've already indicated that CapEx is going to be done over the next couple or so years. But other than that, this thing is spitting out lots of cash. You can see the dividend yield's extremely high, but it's fairly well covered, and they have been engaging in some buybacks, although fairly limited amount of buybacks. They're constrained by liquidity is what I can surmise there. But
so I wrote about Ecopetrol, which is really fascinating. It's in a similar boat. They're the kind of national oil company of Colombia. Colombia, so the people that follow Colombia, the odds are really strong that in the next election, the current president is going to lose, because in all the municipal elections in between. So Colombia, in the last presidential election, they put in a communist guerrilla fighter. Like their president is literally a communist guerrilla fighter who has been very ineffective and very unpopular, and nobody likes him. It's not obvious that Colombia is going to have like a conservative free market Margaret Thatcher replacement. They could have some other kind of replacement, but it is pretty clear that he seems to be going to lose the next election. And so that's only, I think, a year and a half away now that Colombia is going to have a better government, whichever direction they go. It has to be better than a communist guerrilla fighter. But Ecopetrol, under leadership, so when you have this state-owned enterprise, sometimes they're not aligned with incentives with the shareholder. They took their oil profits and they bought infrastructure. So they own toll roads in Argentina. They own utility transmission lines. So Ecopetrol, if you just look at them as an oil company, you're missing like 2/3 of the picture, because they've taken all of their profits under bad presidents and done a bunch of other stuff. So it's this enormous company that's trading pretty cheaply. And then in South America generally, because it's not like the US, where since Rockefeller, we've drilled every square inch of all these parts of the US where the easy stuff has been gotten. In South America, there's a lot of easy stuff that hasn't been drilled yet because Colombia has been a failed state for so long. So when you think about like legacy oil fields like Saudi Arabia, where like, oh, their lifting costs are $5 a barrel. Colombia still has some of those. Colombia still has places where they can drill and they get lifting costs of like $5 or $8 a barrel because they haven't been drilling there for 100 years. So it's very interesting. If you think Colombia is going to have better governance on the next election, if you like these places that haven't been drilled and still have this easy to access low hanging fruit, if you like all of their energy infrastructure, I have a nice write up on my Substack about Ecopetrol. I really like. I like them better than Petrobras, even though Petrobras out of Brazil has some huge followers. Anyway, I've got a bunch of companies written about it. I do like Ecopetrol, and I will look at Petrotal.
Yeah, and McBuda, actually, he's one of our guys in the server who is one of the energy aficionados. He's saying Vermilion acquisition, which
Yeah.
and then he's adding to the Petrotal conversation. Petrotal might also be benefiting that as they're bidding on fields in Ecuador. No, Petrotal. Look into that one. That one is interesting. Yeah. Completely, kind of just like overlooked. No one really talks about it. I tried to refrain from talking about it actually publicly, just given the liquidity. This is going to go public, so it's private to public. So if people see this is the only time I'm really going to do a public discussion on Petrotal. But it's for all the oil aficionados, I try to put this one in their radar. So
so on the Vermilion Energy acquisition, they acquired an asset that was adjacent to their other assets. So if you look at the synergies, if you look at the map, like the two assets come together and make a really nice framework. So as far as synergies, as far as having to cross over other people's lands with pipes, things like that, there should be some synergies on the asset. What people don't like about it is it was natural gas heavy. It was oil light and natural gas heavy. And natural gas in Canada does not trade at huge premiums. And the government in Canada under Trudeau and maybe now under Mark Carney have not been good about building pipelines to get this stranded natural gas. Yeah. So, is it going to be $1 Canadian per MMBTU for natural gas, or is it going to be $3 Canadian per MMBTU for natural gas? We don't really know what the natural gas price is going to be. If you do have the export terminals picking up on natural gas, if Canadian natural gas hits any decent price whatsoever, and they've got like a 25-year inventory with lower cost synergies to extract it, it doesn't have to be a terrible acquisition. So however good or bad the acquisition is going to depend on what the natural gas price does in the future in Canada. So, and I don't have a great opinion on that. And I am a little disappointed in the recent election, and to do the same thing over and over and over again and expect different results. I feel sorry for our northern neighbors.
Yeah. Carney winning was, I think, a surprise to some how quickly it changed in terms of like projections. But yeah, and I don't follow Canadian politics as closely, but I've been watching, I think, Carney speak out of any prime minister in Canada ever that I've ever listened to. I've never paid so much attention to a Canadian prime minister before. It seems like in some of the speeches prior, he was talking about opening up energy potential, but then after winning, there was a lot of discussion speech that he's not. So it's just going to be more of the same, because I think he didn't win by a strong majority. So there's some compromise. Some of the Canadians were explaining it to me. There's some compromise he has to do with other parties now, which complicates it. So some of the platform he was running on before, the Liberal Party, I should say, they have to concede at least some of the energy parts.
I mean, the real because Trump. So Pierre Poilievre had said some not nice things about Trump and things like that, and Trump had said he would prefer working with Mark Carney, and that endorsement didn't scuttle Mark Carney's chances. And the conspiracy theorists that think Trump is into 4D chess think that this was all a long-term plan to get Alberta to break away. So anyway, I don't put much stock in the 4D chess conspiracy theories, but if Alberta breaks away because of Mark Carney's election, then that's what the conspiracy theorists are pushing for.
Yeah, I mean, I would assign that like a next to 0%, but I did see that there was that comment from him saying he would prefer to work with Carney, and then I couldn't help but laugh a little bit. Like the day of the election, he starts tweeting, like the 51st day comment, fully knowing like obviously what the effect would be, and I mean that was I don't know I wouldn't call it a landslide, but definitely an upset from where we thought things were going to go. And it looks like if you looked at the breakdown of different generations in Canada, what their priorities were, the boomers were the ones, unlike the others, who didn't prioritize cost of living, economics. They were, challenge Trump.
Yeah. Yeah, and
Devoted.
that's unfortunate. Well, both Canada and the EU. So in this tariff situation, and so I maybe I can stop sharing because I can pull up. So I did a piece. I try not to do too many macro musings. I try to let me stop. Okay, so let me pull up a chart that I showed. So I don't do too many macro musings, but I did do a write-up on tariffs. And what a lot of people aren't hearing about the tariff situation is the United States has the lower trade barriers than all of the countries they trade with. And so in some ways, they're just sort of trying to rebalance that. Now, Trump wants to take it to the extreme where it's not just about getting equal trade. It's about getting trade, reversing the current situation where instead of other countries having more trade barriers on us than we have on them, going from the United States with the lowest trade barriers to the highest. So I think if you show this chart that I'm sharing, this is from my macro post on tariffs.
Got it here.
So on all this conversation on tariffs, people saying, oh, the United States putting these trade barriers is so bad. The United States is so bad for doing it. Well, why aren't all the other countries in the G20 so bad for doing it to us first? So all this conversation about the Trump is so destabilizing everything, Trump is so bad. Everybody else is putting their trade barriers on the US much more. And what Trump, so instead of trying to equalize this, instead of trying to bring everybody to 10, Trump wants to be at 10 and have everybody else be less than 10 to us. So Trump's negotiations is to flip this, where instead of South Korea having 25% trade barriers on us and us having 5% on them, we're going to have 10% trade barriers on South Korea and they're going to have less than 10 on us. So not only is Trump trying to equalize this, he's trying to reverse it so that the United States has more trade barriers than everyone else. Oh,
and these figures are from B of A research.
B of A and the World Bank. So there's some jerks in Switzerland who make $200,000 a year and don't pay taxes, who have spent their entire lives collecting this data. But one of the points of my article on tariffs is that this data is all bad. So, for example, Canada has import restrictions on dairy, which uses an import quota system, but that quota they only use 26% of the quota. So you can calculate quota as a tariff equivalent, but then how do you calculate it de facto? Only 26% of the quota is used because they give it to an oligopoly that, on the wink, wink, on the hush, just chooses not to buy the stuff in the first place. So every country in the world has dirty tricks to protect their pet industries. Trying to quantify that is a fool's errand. So Trump saying, hey, here's a 50%, here's a 70% tariff. Why don't you come to us and you decide what you're willing to do for us, rather than us trying to figure out for every good in the world and every country in the world and try and complain to the World Trade Organization about everything and try and do a million lawsuits. Why don't you figure out what you're willing to buy to the US and come back to us and take 90 days and figure it out? I don't think that's a bad strategy. So again, what's kind of missing from the tariff conversation is everybody else has higher tariffs on the United States than the United States has on them. And this was by design. So after World War II, the United States says, we're the world's only superpower. We're going to rebuild the world. But now that we have a peer rival in China, it's about going to the West and saying, okay, everybody throw some money in the hat. If we're going to be a peer rival in China, we need all of our allies supporting us. And this relationship where the United States has the least trade barriers has to invert and has to flip. That's not a crazy idea. What is bizarre is both Canada and the EU saying we would prefer to embrace China and as a trade partner than the US, because everything they allegedly hate about Trump, that he's some evil nationalist. Well, how nationalistic is China? The idea that the European Union and Canada want to embrace China rather than throw some money in the hat so that the United States can counter them as a peer rival is insane. And I think it's probably a symptom that all over the West, and again, just like I mentioned, the World Bank ease of doing business report, that isn't produced anymore because China bribed them and they got caught. So how many governments in the West are completely under the control of Chinese bribes? When I see something like the European Union saying, we are going to fight the United States tooth and nail every step of the way, for what? For correcting this imbalance that already exists, and then that they're going to embrace more trade with China. I just see a world where I think it's entirely possible that the bribery culture of China has overtaken so many Western nations. So, because you see Japan, you see Vietnam, you see South Korea all saying, Trump has legitimate concerns, we're going to come and negotiate with him. You see Canada, Chrystia Freeland said, we're going to go to the UK and try and get nukes so that we can counteract Trump. This is the talks of insane people. I think the trade wars might go on the longest with the EU and Canada, and partially because, how many of their politicians are in the Chinese camp, which I remember news stories from back in the 90s. I mean, there was a scandal in the United States in the 90s that Bill Clinton had accepted $2 or $3 million in campaign contributions from China. This bribery of Western politicians has been going on for decades. There was, and I'm not trying to get too partisan, right versus left. I think this is a bipartisan issue, but there's a congressman in the U.S. His name is, what's his name? Eric Swalwell. And if you look at the story where he was set up with a Chinese honeypot, right? So a Chinese spy was, seducing him or his brother, whatever the story is. But if you look back at how early in his career it was, he was a city councilman at the time. He wasn't a U.S. congressman. So this is, Chinese are willing to send spies to do honeypots on local elected officials. That is a terrifying amount of infiltration of Western governments. So I think in this, what's missing from the tariff conversation is that Trump is not insane for wanting to undo the current situation. It's not crazy to think that if we're going to counter China, it has to be flipped, where the United States has more tariffs and other countries have less. And that the Chinese infiltration of Western governments through honeypots and blackmail and bribery has been going on for decades, starts at local elected politicians. I mean, the Eric Swalwell is all public knowledge. Check out the year that Feng Feng did the honeypot on him. He was a city councilman. He was a nobody. Like, the Chinese are sending the spy who loved me to local city councilmen. This is crazy stuff. So when I see the EU and I see Canada saying we'd rather trade with China than the United States, I think it's all bribery and blackmail of the major political parties. But that's just me.
No, there's definitely the term to describe this is elite capture. And then there's actually an instance right now that I caught the compound using information from Bloomberg. I tweeted it out. I know that we only just started following each other on Twitter recently, but I tweeted out not too long ago when one of the members asked me to just look at the compounds video and react to it. It was nothing about what I complained about. It was more to do with recession fears. And they brought up this chart here. I'm going to share it so you can probably, and so the audience is following along. But man, you're looking at this and you're like, wow, this is a subtle but deep issue. Hold on, here it is. Okay, share this tab instead. Remove add. All right, so this image here. So S&P 500 stocks exposed to China taking a hit. They were just reacting to this on the podcast, The Compound. Down there, you can see where the data comes from. Data via Bloomberg Financial LP. Something should immediately pop out to you if you're, even vaguely aware of the revenue streams of some of these companies. The three that I called out in particular was KLA, Lam Research, and Applied Materials. They are saying that China revenue exposure for Lam Applied is roughly 50, and KLA is getting close to 70. Do you know what they did?
What's that?
Well, I say it in the description there, but they added Taiwan, and they said it's all China.
Oh, yeah.
And so that, even though it's subtle, it's a detail that really does matter, because first of all, in the investing world, those details, especially those details, matter, because that's not China exposure. So let's say there is a tariff, because that was the context of this discussion. The context of this discussion was tariffs and then trade barriers or trade bans that could occur on China, and then the risk here. So if you're an investor and you're looking at this and you're saying, oh, I'm definitely not going to invest in Lam and Applied, and I'm going to do no further research. I'm just going to avoid them completely because half of their revenue is China. It's not at all. For Lam, it's less than 30% now, I believe. And for Applied, it's around the same. For KLA, it's also nowhere near 70%. A lot of that revenue is coming from Taiwan, because they have quite a bit of foundries there, TSM. And they're just bundling it all together. And if you're not aware of that, you kind of just look past this and say, oh yeah, nothing's wrong with that. But it's a subtle detail to show you that Western media in the United States, basically placates to the propaganda machine of the Chinese.
Yeah, well, Americans aren't really prepared to think of the nation state not as a regional boundary, but as an ethnicity. So you go back to Europe 150 years ago. There was a big push for the boundaries to match the ethnicities, like the unification of Italy and things like that. And you even have in Greece, they were destroying 1,000-year-old monuments to glorify the 2,000-year-old monuments because they wanted the traditional Greek things versus the later like Christian monuments. Like they were tearing down 1,000-year-old structures so it wasn't an eyesore on the 2,000-year-old structure just for promoting nationalism. My wife is Bulgarian, and in Greece they found a really important archaeological Bulgarian find. They immediately just bulldozed the thing because it wasn't Greek. It was a Bulgarian ethnic archaeological dig. So nationality in the U.S., we're a melting pot. It's just geographic boundaries. To China, the nation is the people, right? And so this is an ethno state. They're sterilizing their minority populations. They're harvesting their organs, and they claim divine right to rule over the entire Chinese ethnic group, which includes Malaysia, which includes, they've got colonies in Indonesia. They claim control over Korea, Taiwan. And that's very important because in their minds, they are morally right. If you've got enough Chinese population in California or Vancouver, like the United States is theirs by divine right. Canada is theirs by divine right because they have control. Like they are the Chinese people, the Chinese ethnicity, not some geographic boundary as it exists now. And the United States is a melting pot. The United States is the 50 states. It is the boundary. We're not, the ethnicity of America. But to the rest of the world, a nation is the people. And the Chinese, they claim divine right to rule over the entire Chinese ethnicity. So when you have a large ethnic minority in your country of Chinese, you expect the Chinese Communist Party there trying to take total control of your government with all of their trillions of dollars of GDP, as is their divine right as the caretaker of the Chinese ethnicity. And which is why it's so boggling. If people on the left think Trump's nationalism is so evil, because in the leftist zeitgeist, nationalism, right? So the left wings are the socialists, the right wings are the nationalists. Nationalism is evil. That's who Hitler was. That's who Mussolini was, completely forgetting that Stalin killed 60 million people and Mao killed 60 million people, whatever. The evil thing is the nationalisms, and Trump's nationalism is evil. Trump is the new Hitler, completely ignoring the fact that Chinese are way more nationalistic, right? That Chinese are much, much more of an ethno state, a nation state, and are much more nationalistic than Trump could ever be. When you see Canada and Europe both saying we'd rather trade with China than work out a deal with Trump, it's just shocking that how inconsistent it is with their own ideological system that they would look at such an aggressive nation state as a nationalistic entity as China and think it's preferable to Trump. It's just mind-boggling. But that's what we're at. Where Mark Carney said, the relationship with the United States is ended. Chrystia Freeland said, we want nuclear weapons to counter Trump. Like this is not reasonable talking, right? This is crazy stuff.
I kind of am optimistic on that sense that Carney's commentary on that was like very hyperbolic, because like now I look at him now and he I don't know. That's what I'm saying. I've been listening to him more than I've ever listened to any prime minister in Canada ever. I've never cared to listen to Trudeau. And 2 days ago, Carney praised Trump as a wonderful negotiator, one of the greatest negotiators, is I think he said. So I view there was probably like this whole hyperbolic, the relationship's over, and then there's a meme. It's nothing ever happens meme. Sometimes it's applicable, but in this case, I view that there's factions, and optimistically, I think the factions that are more, U.S. centric are going to prevail. In the case of Europe, I'm aware that the strongest party or the strongest voice in Spain, for example, as a faction, they are going to be more pro-Chinese, and then there's also elements in some of the other Southern European countries. But then you have other Southern European countries like Italy that's going to be more pro United States, and then there's within each of the other major countries, France and Germany, who have heavy EU influence, they're going to be more pro-US, but there's factions that are going to be more pro-CCP. And then in Poland, for example, they're, I think, overwhelmingly more pro-US.
Yeah.
But I'm an optimist. I think a lot of this is going to be resolved, and the West is going to come together at the end. We're going to look back in 2 years, and the CCP might be in a bit of a worse shape than before, but we'll see.
Yeah. Well, I think you're going to get some resolution for trade deals in the next couple of months. But if I had to guess as to which countries the trade deals are going to take the longest and have the most pain inflicted beforehand, it looks like, Japan and Vietnam and the Eastern countries recognize that there's a legitimate concern and want to make a deal. And the rhetoric out of Canada and the EU are so belligerent. So I would say Canada and the EU might be last to the table. And that could inflict some serious pain. Because, for example, exports as a percentage of GDP, I think exports to the US are something like 20% of Canada's economy, and it's 1.5% of the US's economy exports to Canada. So the pain is not going to be felt equally. Right? Canada can't hurt the US the way the US can hurt Canada. The idea that either Poilievre or Carney were talking tough, like they don't have a place to talk tough from. But just the rhetoric has been so belligerent. And from the mainstream media, that's why I wanted to show that chart to show how low the United States' trade barriers were, because they're making it seem like Trump is this evil anti-free trade monster for wanting the United States to not be in that minority position where our trade barriers are the lowest. Like, how come the UK and South Korea aren't monsters for doing it to us already? And when the UK and South Korea had 20% plus trade barriers, how come that didn't crash the global economy? So that the news media has been giving a very poor explanation of all this stuff. But anyway, so on my Substack, I try not to do very many macro musings, but I have a couple on the tariff situation, because that's my highest degree was in economics. I went to school for a master's in economics. I did the PhD in finance, but left all but dissertation because I didn't care for the research, and my wife had graduated and I want to start making money. And then I was a professor of finance for a few years. And that was all after I was a financial advisor. So I've got some of the economics background, the finance background, the financial advisor background, and hopefully turn that into an entertaining Substack where I talk about degenerate gambling and small cap stocks.
And another time, I'd like to have another conversation with you on that stuff. But overall, thank you so much. We're approaching the 3-hour mark, so we had a really long, fruitful discussion. I enjoyed every minute of it. It was a pleasure having you on. And if there's any last thoughts you'd like to share with the audience, feel free.
No, thank you for having me. It was a pleasure. I really appreciate the invite, and happy to anytime. And so, yeah, I don't get a lot of, the best way that I grow my channel is through these Substack interviews, getting exposure to new audience. No matter how much I ask people on Substack, to retweet things or restack them, it's really through these podcasts that I reach new people, and I'm really grateful for the chance.
Yeah, no worries. So this will go public right around next week. And so the audience here, they're right now the CM members. And then later next week, I'm going to be posting this to the YouTube channel, Twitter, etc. So no, it was very much a pleasure. I'll definitely love to have you on again another time.
Oh, thank you very much. I'd be happy to.
All right. And everyone, feel free to check out all of his stuff. You can find him on Substack, his name, Unemployed Value Degen. And if you're watching this publicly later on, you can follow him on Twitter. You can follow him on Substack. Just search Unemployed Value Degen on both of those platforms, correct?
Yep. Yeah, I'm Twitter. I think on Twitter, I might be Small Cap Unemployed Value Degen. On Substack, that didn't all fit into one thing. But yeah, Unemployed Small Cap Value Degen on Twitter, and Unemployed Value Degen on Substack.
Thank you so much for coming on. And for everyone, we'll see you guys next time on the next icon.